Hello, everyone. Thank you for joining us, my friends, my colleagues, my fellow doers, thinkers, risk takers, game changers. I just want to thank you for joining us today for this epic event. My name is Ben Weiss. You likely know me as Ben from Flippa on the daily emails that provide you insight on great new digital business listings. You've been hearing about it for the past couple of months. 2,500 of you have registered to attend, and it's hard to believe that the day has arrived for our first annual Own Your Future event. Now, I love hearing a little bit of data. I often find it quite compelling, so I wanted to start the day with just a couple tidbits that might get you hungry for what you're going to hear today. Number one, according to Salesforce, millennials and Gen Zers are 188% more likely to start a side hustle than any previous generations. We are living in a side hustle economy. Now, according to Guided Financial, 55% of people who are opening their own businesses, they're doing it because they want to become their own boss. And on top of that, 39% of those people are doing it as a means of pursuing a passion. It is a time to invest in ourselves and invest in our dreams. Number three, the statisticians at NASDAQ predict that by the year 2040, less than 20 years from now, 95% of purchases will be transacted online. Digital is the present, digital is the future. We're going to be taking you on a marathon journey today as we think more and more about investing in ourselves as a means to own our futures. We have 8 different speakers lined up, each hugely successful in their own right, and each with their own take on what it takes to become successful business people yourselves. Now, these speakers will be inspiring you to get out there and invest in your businesses, invest in your education, invest in your clients and your customers, and most importantly, invest in yourselves. Now, after all, that's what we're here for today. We're looking to come out at the end feeling refreshed and revitalized, ready to move forward with our next side hustle, ready to become our own bosses. As mentioned, this is going to be a marathon, so use the restroom, get yourself a sandwich, because we're going to be here for you all day long, and we do hope that you will stay with us. Now, of course, for each presenter, time permitting, we will be taking questions from the audience, so use the tab at the bottom of the Zoom window to ask questions that are relevant for each speaker. We'll do our absolute best to filter through those and get to as many as possible, but we obviously won't be able to get to everything. But now, without further ado, I am excited to introduce our first speaker for the day, a business visionary who has led operations and strategy on teams across the globe from the US to Australia, companies like Xero and Luxury Escapes, and currently serves as the CEO of Flippa. A gentleman who I am happy to call a colleague and a friend. Throw your virtual hands together as we introduce Blake Hutchison.
Thank you so much, Ben, and thank you very much for that warm welcome. I should say it is 3 a.m. here in Melbourne, Australia. So as you said, it's going to be a fairly significant marathon. A marathon for all of you taking in all of the insights and the inspiration today, and a marathon for my good self joining you from Melbourne, Australia at 3 a.m. So good morning from me to you, and welcome to Own Your Future. What an incredible time that we all live in. Some of us have been working from home for many years, but for some of us, it's been a new journey for the last couple of months. And certainly here in Melbourne, for those of you who don't know, we've just been locked down again for another 6 weeks as we look to take back control. But enough about that. As the CEO of Flippa, I get to watch from the sidelines as a global marketplace to buy and sell digital real estate and online businesses. I'm convinced that this will be a positive and transformational period for so many of us. New jobs, new opportunities, and certainly many, many life lessons. The conference has come together beautifully. We've got some outstanding speakers. They're hugely inspirational. They've had outstanding careers. They know a lot. They're going to tell us a lot. and we can't wait to hear their thoughts, ideas, and opinions. To kick things off, I'm going to give you a small and quick snapshot. We're going to cover three things. Firstly, digital real estate, and we're going to look at that in comparison to some other asset classes. Secondly, trending topics. We see millions of searches on Flippa every single month, and this data provides us with unique insight. So we'll take a look at that. And then thirdly, different business models. How much can you actually earn if you want to start or acquire one of these businesses? And then let's say you did want to buy one. How much would you have to spend to get your hands on a high-performing digital asset which would enable you to take control of your future? And then, of course, the real stuff starts. We get to these outstanding speakers. So let's do this. In June, there were 30,000 new buyers that joined the Flippa platform. This opportunity is now at fever pitch. There were nearly 4,000 sellers. These people are investors, they are prospective first-time online business owners, and they are those that are looking to supplement or replace their income. They are makers and creators looking to realize or create new value. And as I said, we take a front row seat and watch all of this play out. Business models have matured substantially over the last 5 years. It's now easier than ever before to start an online business. The online business owners themselves are becoming far more sophisticated. The marketing patterns that they use, the way they acquire customers, the cost to acquire customers, it's all changed. There's now also a ready market of buyers, meaning that for small business owners, they can pursue exits with the same upside traditionally reserved for big businesses. This concept of acquisition entrepreneurship is becoming mainstream. It's often easier to acquire something with traction than it is to start something from scratch. But regardless, there's more people than ever before moving into online business, and it's exciting to see. But how about this? Ben gave you some outstanding statistics. It talks a lot to the transformational nature of the world today. 40 to 70% growth in consumers who purchase most or all of their items online for almost every category. Now, of course, there have been some categories which have seen some declines, but overall, the trend to online is creating opportunities for all of us. And that's what we're here to talk about today. So some industries are substantially up. Some industries are facing it tough right now. Traditional occupations are being challenged. But the real question is, will it be a transformational time for you? Is it time to acquire? Is it time to start? Is it time to sell? What training, what lessons, what can you take into the next few months which will set you up for the next 5 years? Tech use has changed dramatically. Not only the number of people, but also the frequency at which people are using tech has changed forever. And not only that, platform accessibility has made it easier than ever before. Shopify is now the second largest retailer behind Amazon. And of course, they don't sell anything. They provide a platform to make it accessible for online business owners to get up online and trade. So almost all online business owners today are benefited by utilizing low-cost, high-impact, and widely accessible platforms. As we keep saying, and I'm sure you'll hear today a lot, the time is now. So let's take a super simple view of the world that we now live in. This looks like a wonderful home. Wouldn't mind living in that one. It's probably got a beautiful view. But if you choose to invest here, and many people do, It's arguably the most widely recognized and understood asset class. You could probably, depending on the location, depending on where you are around the world, you could perhaps expect to get a 5 to 7% annual return on your investment. Sounds pretty good. Or take the prior 10 years. Let's have a look at the S&P 500 and let's look at annualized returns. 7 to 8% annual return, pretty good. Takes a brave investor, very knowledgeable investor, to enter this space right now. Or how about this? We're talking about an undervalued, less well-recognized alternative asset class. Investing here in an online business should enable you to return 30 to 40% ROI per annum. Now that is outstanding. That is where I place my money. That is where Flippa orientates its attention. And you'll hear from lots of speakers today talking about lots of inspirational topics, places to invest, ways to use your money, etc. But this is likely to be a recurring theme. And it's a recurring theme because right now there is a community of buyers feasting on what is still an undervalued asset class. So let's have a look at some of the numbers. This is quite exciting. So each month, Flippa takes a look at the way buyers are using our platform. We take a look at the way buyers are using our platform because it gives us exciting indications of where demand is among a sophisticated few who are looking to acquire online businesses. And there's a few that have been at the top for a long period of time. AdSense-powered websites are considered safe bets. AdSense is the #1 search term on Flippa. Amazon, and that could be either websites powered by the Amazon Associates program, which of course is Amazon's affiliate business, or it could be e-commerce businesses powered by FBA, fulfilled by Amazon. Amazon's powerhouse distribution and user acquisition platform, giving small business owners access to their incredible leverage and network. So those two are often at the top. But where it gets more exciting is what we're seeing in the category and industry space. And as you can see in items 6 through 10, there's been this dramatic shift away from certain industries like travel. And that industry and many others have been replaced by industries and categories like fitness, music, and health. The topics and the categories that, be it a content business or an e-commerce business, can thrive upon today. There is so much demand right now. And so if you have something that is in one of these industries, it could be the perfect time to sell, albeit I respect that you're probably leveraging the opportunity right now. In turn, if you're looking to buy, this is where the competition is hot. This is where valuations are being pushed up and to the right. And then of course you've got the mainstays. People are still looking for blogs powered by ad revenue, affiliate revenue. They're looking for small SaaS businesses, and everyone's always on the lookout for well-optimized SEO businesses or those businesses that provide VPN services. Now, of course, there's lots of data that we can share, but one of the things we do love doing is looking at this top 10 every month. So to round this out, before we kick on to these exciting speakers, far more exciting than I am, let's take a look at these different business models and let's take a look at some real examples, because there's really two questions that I think people should be asking themselves. If you're getting into online business for the first time, or if you are an established online business owner today, you want to give yourself a benchmark. How much can you make? And then secondly, let's say that you're looking to invest for the very first time. Let's say you want something which has established traction. We want to know, how much do you need to spend? So let's take a look at 3 quick examples. The first one is a website called personalitymax.com. It's an AdSense powered site that provides personality testing. The awesome thing about Personality Max is it's mostly a passively run business. There's very low operational overhead. The business was operating for 9 years. And for that 9 years worth of effort, albeit only spending a few hours on the asset a week right now, that business was making nearly $45,000 per annum. Now, I tell you what, if you're working a 9-to-5 job, almost anyone would love to see an incremental $45,000 per annum into their bank account. That's fantastic supplemental income. But here's the thing. This is a strong performance business, as I said, operating for over 9 years. Now, if you wanted to acquire a business like this, you would have had to part ways with $254,000. So $254,000, run it the way it's been running, and get yourself an annualized return of $43,500. That's a content site backed by AdSense. And then how about a small SaaS business? The great thing about these smaller SaaS businesses, particularly if they're well optimized, well run, well built from the start, is that again, you often don't have to spend a huge amount of time to get some supplemental income. This business, watermarquee.com, which was providing a watermarking service for photographers, wedding photographers, event photographers, etc. It had been operating for 8 years and it was making nearly $14,000 per annum. Now, to get $1,000 plus into your bank account, again, fantastic supplemental income. And a lot of people are buying these websites as investments. They are absolutely using them to supplement, not necessarily replace their income in full. And in this particular case, a 3 times annual net profit multiple saw this business sell at $43,000. So we've gone through a content business quickly, gave you a sense of how much you could earn. This is a SaaS business, gives you a sense of how much you could earn, how much you'd also have to pay to acquire an asset like this. And then lastly, e-commerce. Now, the prior 2 examples had been in operation for longer periods of time, 5 to 10 years. In the case of Blue Tees Golf, it's an e-commerce business. It's got a diversified revenue source in Amazon as well. But it's very different. Operationally, it's advertising heavy. Huge amounts of money spent for an ROI. That money's most likely spent on Facebook marketing. It's been operating for far less period of time. And as a result, you can see the multiple impacted dramatically. But again, still pretty good going. There's very few of us who wouldn't want an extra $110,000 per annum into our back pocket. As I said, the multiple is a little constrained as a result of its operating time, as well as the way it operates. E-commerce tends to be a little more hands-on than, say, a content or smaller SaaS asset, and therefore less of a high purchase price at $160,000. So that should give you some sense of the types of buy prices as well as what you could earn. The critical thing is there's so much movement in this space. There really has never been a better time. The time is right now to own your future. We have some outstanding speakers coming your way, and I hope you have a fantastic conference. Thanks for joining us today.
And without further ado, introducing our first guest speaker for Own Your Future 2020. He is the author of 20 books, including the bestseller, Choose Yourself. He's the editor at the Altitude Report and hosts the James Altitude Show podcast that has over 40 million downloads. He's started 20 companies, 17 of which have failed. He's achieved the rank of chess master, and he's a strong believer, from what I understand, in the power of a cup of coffee when it comes to getting things done. Let's put our virtual hands together for a silent applause for our man, James Altucher.
Thanks everybody thanks Ben and Blake for inviting me. I'm curious actually, if you type into the Q&A, where are people from? I'm just curious how worldwide this is. And, and you can start asking questions. I'll start answering them at some point. But I wanted to comment on a few things. I got very excited about Flippa completely independent of knowing Ben and Blake. I somehow stumbled on the site, and it was like my dream come true. So I always believe that much more interesting to buy an existing business than to start a business. So I think for VC funded businesses, they always quote like, oh, there's a 90% fail rate. Maybe that's true, maybe it's not. But if you buy an existing profitable business, your fail rate goes down enormously. Like if I buy a laundromat at a popular corner, my chances of failing or not being profitable is almost non-existent unless people stop doing laundry, which if most people were like me, then I would be in trouble. I don't like to do laundry that much, but again, buying an existing business is so much better in terms of having a successful business model. Now Blake was talking earlier about you could, buy some of these businesses fairly cheap on Flippa. You can buy them as standalone businesses that you can, have as a side hustle. So you have your full-time gig, and then with only a few hours. I think the initial attraction of Flippa is that I could buy some e-commerce business that sells jewelry or whatever, or some game, and I barely have to pay any attention to it, and I just make money while I sleep. I think that's kind of one possible dream of Flippa. And by the way, I'm not affiliated at all with Flippa, but I am excited about other business models that make use of the Flippa model. So let me just take a look at this Q&A, see where people are from. New Jersey, that's where I'm from. New York, where I'm from. Cleveland, Ohio. Great. So all over the world. Good job, you guys. And that's an interesting thing too. I think people have traditionally viewed the economy and entrepreneurship in a very one-dimensional manner. Either it's up or it's down. So either the economy is going up and hey, we should all start a business, or it's going down and we should all hide under our covers until this period's over. And then there's sort of this two-dimensional way of looking at business, which is that, there's this saying, at any given moment, some industry is in a bull market. And so you don't just look at one industry, which might be up or down, many industries. So, right now, obviously, we're all on Zoom as opposed to having a real conference. Not that this is not real, but it's a virtual way of meeting each other. So Zoom and other video conferencing platforms have done enormously as an industry. In fact, I've seen at least 2 or 3 startups in the past 2 or 3 months that are building new video conferencing platforms, whether for events or meetings or learning or telemedicine or podcasting. This industry is in inning 0 still, the video conferencing industry. And this is just one industry that's in inning 0, which I'll get to in a moment. But that's the fact that there's a three-dimensional way of looking at entrepreneurship, which is that right now, yes, the economy feels horrible. It feels like everything is uncertain and the economy's down. In the US, there was initially 40 million layoffs. Now I don't know what the number of unemployed is, but it's still pretty horrible. There's like an 11 or 12% unemployment rate. It just feels awful. But that's back to the one-dimensional way of looking at things. Everyone on this conference is prepared to look at things in a three-dimensional way. You're here because you're looking for opportunity, not because you're trying to get back into the workforce or get your old job back or wait for the furlough to be over or wait for the UBI. You're looking for new opportunities. And I think that's the three-dimensional way, is that trillions of dollars have been dropped onto this economy, not only by the US, but by every major government. And essentially those trillions of dollars, let's say it's like $5 to $10 trillion is right now sloshing around in the world economy, but has not yet found a home. We don't know where it is. It hasn't fully hit the markets. It hasn't fully hit your pocketbook or wallet, but it's here. That money has been basically airdropped onto the world, trillions of dollars. And so the key for all of us is to figure out, where is that money going? Now, it might not be going into restaurants or movie theaters or, cruise lines. The fact that they even considered bailing out cruise lines has to be the most ludicrous thing in the world. There are cruises still on the ocean which have not docked since early March, which is insane. But America wanted to, I think they initially earmarked something like $50 billion to bail out the cruise lines, which always tells me America, no matter what you say about the US is always number one at figuring out how to get people into a buffet line, and hence the interest in cruise lines. But that said, I do think what's exciting to me is buying an existing business, but not necessarily. I think it's interesting to buy one business and have it as a side hustle and try to grow it. Like, let's say you buy an online, jewelry business, or let's say you're looking at what's trending on Kickstarter. And I think about a month or so ago, there was a bread machine product trending on Kickstarter. And that's interesting because during this period, since the economic lockdowns worldwide, what are the main themes that we're seeing? We're seeing, obviously, the theme of remote. We're all from around the world, and yet we're sitting in our homes. So remote is key, and I spoke about that already. We're also seeing safety is an important theme. So, for instance, the mask business, the disinfectant business, right now trending on Kickstarter this moment is a product for hygienic doorknobs. So doorknobs made out of brass, because brass is part tin, part copper, and part copper. Copper is an antiviral. So it's always interesting to see what's trending on Shopify, what's trending on Kickstarter, what's trending on Google Trends. So bread machines were trending for a while because bread is like this comfort food. We want safety. We want comfort. We want to be happier. So during this lockdown, people started cooking, making their own bread. And so let's say you were going to buy, let's say there's some Flippa site out there that makes bread machines, and for makes $20,000 profit a year. You buy it for $50,000, so 2.5 times earnings, and that's an interesting buy. So you'll make an extra $20,000 on the side. You'll be happy, and then maybe you have some ideas to improve it. So the $20,000 can go up to $25,000. Like, maybe you'll do affiliate deals with other product companies. Maybe you'll sell your email list. Maybe you'll sell other products. Who knows? There's various ways you can improve a standalone business. And I think that's fine. But I think there are other business models that one should consider in this world. One is, let's go meta for a second on Flippa. So why can you buy a business that has $20,000 a year in profit for just $50,000, 2.5 times earnings? It's as if you're buying something and you're getting, it's as if you're buying a bond and you're getting a 40% dividend, which is enormous. That's dirt cheap that you could buy businesses on Flippa. It's because those businesses are small. So the smaller a business is, it's usually viewed as a little bit riskier, and you could usually buy it for a cheaper multiple of earnings. So one business model that one should think about is, and this is one that I've been thinking about, is don't just buy one pre-existing business, buy 100. So you buy 100 of these e-commerce sites, and let's say they're all in the e-commerce area, so you can combine them and have some sort of back-end synergies. Like, you can combine all the accounting. You can maybe combine what you're paying for storage on AWS. You can maybe get a cheaper deal on drop shipping and storage and physical storage of products. So if you buy 100 of these products, of these sites, there's ways to build a business just by combining back-end synergies. But what ends up happening is when you buy 100 of these businesses, the multiple that you can value the business at goes up. So instead of, when eventually you'll be able to sell the business not for 2.5 times earnings, but for 20 times earnings. So that's one business model, which is buy 100 of these, improve the profits one by one, but also improve the valuation of the entire business. You buy all of the earnings for 2.5 times earnings, and you sell it all for 20 times earnings. So this is the way to start thinking. Look for trending items, focus on, safety, remote, all these other trending models in this environment, and then go meta, buy lots of these earnings flows and sell for a greater multiple of earnings. Similarly, you could be a lender to people who want to buy on Flippa. And, if everybody's making 40% on their earnings, you could start lending people at 20% interest rates, and that's a decent business. You could raise money for that. You could grow. It could be a the last two business models I described, lending plus aggregating hundreds of these businesses. These could be 10, 20, $30 million businesses in the long run. And a great example from the OOs was Demand Media, which bought and combined hundreds of small e-commerce businesses and was very successful doing that. It ended up being a multi-billion-dollar company. So, and another thing to consider too is that, you don't have to put up all the money yourself. There's various deals you could do with these sellers. You could raise money like a hedge fund. You could also create an information business about sites like Flippa. So Flippa is my favorite site in the space, but there are other sites where you could buy and sell businesses or other streams of online income. So imagine you can create an online newsletter, charge $100 a month, and analyze different businesses you could buy across these platforms and make suggestions about, show how you do due diligence on each one of these businesses. If you're charging $100 a month and you get 100 people subscribing to your newsletter, that's $10,000 a month. It could be the newsletter business about buying and selling these online e-commerce businesses. That in itself could be another way of going meta to make an enormous amount of money. So I'm going to start answering some questions. Please feel free to ask. So someone.
Yeah, I'll jump in here if you want, and we were collecting some on the side for you to make it a little easier because I know a lot was coming in.
Okay, Ben? Do you want to ask me the questions?
Yeah, I'll jump right through them, and I really appreciate that you talked yourself or all of us into essentially becoming our own bank and bankrolling all of these investors. That's amazing.
And by the way, that diversifies the risk considerably. So you're not just buying one business. And again, the way you're managing risk is the more businesses you buy, the higher valuation you can charge when you combine them all. And the greater your profits could be by combining some of these back office needs that are replicated through each of the businesses. So this is a great way to go meta on Flippa. Or you could do the newsletter. I just almost said newsletter, but you could do a newsletter about Flippa style sites and how to buy and sell these businesses and which businesses right now are attractive and what's trending and what's not. And then you take almost zero risk, and that could turn into a huge business. So right now, thinking three-dimensionally, how to get a hold of this extra $5 trillion that are being airdropped onto the world economy, this is the way to think of things. So anyway, go for it on asking me questions.
Yeah, we got a good one from Tammy. She says her biggest concern with buying a business is the ability to run it the way that the current owner has run it. I was wondering if you can speak to that.
Yeah, so that's a great question. So let's say you buy a business, and the owner, the previous owner who sold you the business disappears, and then suddenly all of your customers and vendors disappear. The people selling you product and the people buying product, they all disappear. That's a catastrophe, right? So that's what you're referring to. That's the main nervousness I would have in buying any of these businesses. But that's why you do due diligence. So once there's a deal that occurs, once you guys settle on a price, there's always a quote in every deal term sheet. This is all done pending due diligence. So you call up the vendors who are selling you product. You analyze on a big spreadsheet who all the customers were. How did the customers arrive at this site? Did the customers arrive through Google search? Did the customers arrive because they were friends of the previous owner? So you need to do due diligence, and that's critical. But the more due diligence you do, that solves the problem. And there are many areas on the web where you could just search due diligence checklist, and you'll see a pretty good checklist for how to do due diligence on businesses like these.
Good stuff. Good stuff. We've got Max, who's curious. He says, given the current skew between potential buyers and sellers, if he's got the numbers right, is it time to sell or time to buy?
Great question. And of course, it depends on the industry. So let's just say, let's just not look at Flippa. Let's look at the world in general. It is the wrong time to buy a restaurant in New York City. So that's like an extreme in one area. It's probably the right time to buy a rising video game app, mobile game app, like, or e-commerce. Again, you could look for, you could Google what products are trending on Shopify. So Shopify has over 1 million individual e-commerce stores. And if you see, oh, this is pretty consistent, this product is trending on Shopify, and then you could look on Flippa for the sites that are selling products similar to those trending products, those are probably good industries to go into, or at least it's a clue. By the way, validating a product is very important. So let's say you want to check the demand for, you're unsure, you're thinking of buying some e-commerce site and you're unsure about if there's demand or not going into the future. Like maybe this was just this past year, past 2 years, maybe it's not going to be in demand going forward. Here's an idea. Take a picture of one of the products on the site that you're thinking of buying, put up a bunch of Facebook ads. You want to experiment with different Facebook ads, and then see what the click-through rate is on those ads. You just have to put $100 budget per ad, see what the click-through rate is. You don't have to link to anything because Facebook will tell you what the click-through rate is, whether those ads are linking to anything or not. If you have a 2 or 3% click-through rate, then you just validated your product. That's a decent product. And people like the picture, they like your ad, they like the headline. 3% is enormous, and that means your product is good to go. Then you could start bidding on the Flippa site or whatever else. So I forgot the original question, but maybe I answered it.
Should we be buying or selling?
So if you validate the product, you should be a buyer.
It makes sense. I love that. That Facebook trick is genius. We've got
by the way, I use that Facebook trick for everything. If I'm thinking of a title for a book, I'll put up 4 or 5 different titles, and I'll just see which on 4 or 5 different ads, and I'll see which ad is clicked on the most, and that's the title of my book.
Yeah, I love that. It's $100 instead of thousands in product.
Yeah.
Alex from Germany, he is wondering what you think about leverage. He says, what would you personally indebt yourself to start, and if so, to what extent, and any tricks that might come to mind?
Yeah. So the basic answer is absolutely. I would go into debt, because let's just look at the example that I gave before. You're buying a company that has $20,000 in profit per year, and you could buy it for $50,000. So I think the average multiple of earnings on Flippa or other sites like this are about 2.5, between 2 and 4 or 2 and 5 times earnings. So let's say you bought a $20,000 a year earnings site for $50,000. That means you're getting 40%. You could borrow $50,000 with let's say 10% interest, but that $50,000 is returning you 40% a year in earnings. So gradually, with no money down, as they say, you could pay off the loan in just a few years out of your earnings. So that's the basic answer, but there are some tricks. So the first trick is, can you borrow that money from the seller? So the seller is, most businesses, 90% of businesses, when they end, when the owner is tired of them, they simply shut down. They don't sell at all. And so if you're telling the seller, hey, I'm willing to pay the price you want, I'll even pay you a little bit more actually, but let's work out a deal where I pay you a balloon payment. Maybe I'll pay you $10,000 up front for the $50,000, and then I'll pay you, $8,000 a year or $5,000 a year going forward. And the collateral is the business. So you're getting, that's called seller financing, and many sellers will do it, not all, but many. And they might want a bigger, all those things are negotiated. They might want a bigger balloon payment. They might want half down. They might be okay with 0 down. They might want a quicker return. But seller financing is very common because it's better than just simply shutting down the business and they have no work. And you kind of have no risk, because if the business fails, because let's say all the vendors or customers go away, the collateral is the business. So the business just returns to the original owner. So that's one way I would think about it, seller financing. If you're using a bank to borrow the money, good luck, that banks don't lend money for this. But if you're using like a hedge fund or some other fund to borrow the money, just be careful about the collateral you use. Don't, the collateral should be the business. Try to avoid a personal guarantee, try to avoid your house's collateral, things like that. But there's lots of ways I myself would always use debt, because then again, don't forget, the more businesses you buy, the higher the valuation goes up. So if I buy 20 businesses, maybe now I could flip the whole thing for 5 times earnings, 10 times earnings, when I just spent 2.5 times earnings for everything. So then I go through the math and it works out very nicely for you. If you're selling the whole thing for 10 times earnings, you pay back the loan and you have a nice substantial profit when you put minimal to zero money down.
Good answer.
This is like the private equity market that's existed for the past 40 years. This is how private equity works. It's all leveraged buyouts. This is how that entire market works. But this is inning 0 for e-commerce sites, whereas in the traditional private equity market, it's inning 12, where they're in overtime already, and they've lost, by the way. So it's better to do that type of model here, and it's a model that's proven to work.
Exactly. I like this question because I think we get a lot of people with similar thoughts, myself included. Pawan, I'm probably mispronouncing that name, says, what are the top skills that a newbie should have if they were getting into the online business space?
It's a great question. And I would always count myself as a newbie because the industry constantly changes, right? So maybe 10 years ago, your expertise in search engine optimization might have been an important skill. Now it might be your expertise in, finding cheap opportunities for Facebook ads or Instagram ads, or buying opportunities with TikTok influencers, or finding cheap ads on podcasts. So marketing is one type of skill, but that's a skill that constantly changes. So if you always have to be up with what's the latest, what are the ad dollars that have the most impact? And I would have to constantly assess almost every month what's working. So I guess the skill is learning about that, but google.com is a useful little website for helping you figure that out. And there's also online courses about this and so on. Another skill, of course, is due diligence. We spoke about that. You want to make sure the business doesn't fall apart the second you buy it. You want to be able to analyze financials, but you get an accountant to help you with that if you're not skilled at that. That's a commodity skill that you can easily pay $100 for someone to help you if you don't have that skill yourself. Do you need skills in programming? No. Again, that's a commodity skill you can find on Fiverr or freelance or in your neighborhood, whatever. And then there's some business skills. Maybe you want to be able to do affiliate deals, or you want to come up with other business models. You're selling bread machines, so you do deals with other people, with somebody selling a website selling bread cookbooks, and you do kind of a swap of ads, and you do affiliate deals with people. And an affiliate deal means if you send customers to them, you put an ad on your site, if you send customers to them, you split 50-50 whatever your customers buy on their site, and vice versa. So there's kind of nuanced business skills, but the main skill, I would say, and this is a skill I learned, unfortunately, the hard way, understanding valuation. So understanding that first thing I talked about, why are some of these businesses only selling for 2.5 times earnings, but with some, business manipulation, a little bit, manipulation is the wrong word, but with some business acumen, you could change that 2.5 times earnings to 10 times earnings, which means you don't have to actually improve the business. You just have to improve the business model, and you make considerable money. So understanding the difference between a business model and a business is important.
That's good stuff. We only have a few minutes left. I want to give you a chance for some self-promotion, of course, and we did have a question in here from Josh. Could you just briefly summarize your book, Choose Yourself? What's that all about?
Yeah, so a lot of times you want to do something and people tell you you can't do it. Like, let's say, we're right now, everybody calls this period in our lives, we're going into a new normal. And for some reason, people think we're going back to something that was like the old normal with just some tweaks to it. I don't believe that at all, actually. We're going right now through a great reset, and everything's going to change. Everything in our lives are going to change. If you have kids, you know what I mean. They didn't go to school this past 6 months. They're probably not going to go to school next year. Life is different. And the similar thing happened with the rise of the internet, and throughout history, similar things have happened. But let's say I want to write a book, and I used to think, and I'm a writer, so I used to think, oh no, I got to get an agent, and then the agent has to find an editor, then the publisher has to like it, the marketing department has to like it, Barnes and Noble has to like it. You have to jump through all these hoops, and you have to get everybody to like you in order to publish a book, in order to do your dream. Well, what if everybody says no to me? And what if I think they're wrong? Well, I can choose me. I can just write my book, and now I can upload it to Amazon and I could publish it. In fact, I've published my first 7 or 8 books were with major publishers. And then I decided, you know what? I'm sick of using regular publishers. It takes a year to get a book published. You don't really make all that much money because they get the most of the money. So I wrote Choose Yourself, actually. And I hired somebody to do the cover. I hired a marketer to help me with the marketing. And I uploaded it to Amazon as a Kindle and as a paperback and as an audiobook. I did my own audiobook. And I've sold over 1 million copies. It's my best-selling book. I've made more money from Choose Yourself than any other book that I've done, mainstream or self-published. And I chose myself to write and publish a book. I'll give you another example. Somebody else came to me and wanted to do a docu-series, 8 episodes about the book Choose Yourself and the lessons in it. So they shot a whole documentary and divided up into 8 episodes. And then they were saying to me, well, do you have any ideas? What should we do with this? And I'm like, well, let's self-publish it. Let's release it as a series on Amazon. And then it'll look like any other television series on Amazon. But then I went one step further. Let's take the first 2 episodes and let's put it in movie theaters. So this weekend, it's going in movie theaters all across the southern U.S. And it's fascinating because many movie theaters are not open. So to make the top 10 list of box office for a weekend, you only need to sell about $500 worth of tickets. Normally, you would need to sell $20 million. You have to be an Avengers movie or a Hunger Games movie and sell $20 million worth of tickets to be in the top 10 in the box office. Last weekend, you just needed to sell $279 worth of movie tickets to be. I always wanted to be a top 10 box office hit. I will definitely guarantee that my movie will be a top 10 hit next weekend because I found one of the only movie theater chains that are open. And once you're a top 10 hit, by the way, you're an Oscar contender. So there's so many different ways. If you think creatively, you could choose yourself. You could make your own fashion line. You don't have to be Ralph Lauren. You can make your own fashion line. Order, I'm wearing pajamas right now because I want to make an outerwear pajama line. So I could order pajamas on Alibaba from a factory. I can make them put my logo on it. And I can say we're living in this great reset, this new normal. I just want to wear comfortable clothes. Here's outerwear that's the same as pajamas. I could set up a store on Shopify. I could advertise it on Facebook. And boom, I just created my own fashion line. So you could choose yourself for almost anything that you previously. I would have thought it was impossible to release a movie on 20 movie theaters across the country. I would have thought it was impossible to publish my own book. I would have thought it was impossible to set up my own fashion line. But all of these things you can choose yourself to do.
I'll give you a round of applause on that. Choose yourself, choose pajamas, do what you got to do. I love it.
I'll give one more example.
Okay.
6 years ago, I started doing stand-up comedy. And everybody told me, James, you need to wait in line. You can't do this. You need to be a comedian for 20 years before anyone will let you on stage. You know what? In February, right before the lockdown, I toured all over the Netherlands. I've toured now all over the U.S. I chose myself. I didn't let 100 people told me I couldn't do this, and I did it.
Hey, that's what it takes. The more people say no, it's when you say yes. I love it.
Exactly.
James, thank you so much. My God, next time we're going to need about 4 hours with you because we have a lot of questions. I know you are, a busy guy, but maybe we'll send some of these to you, and over the coming months, if you can answer some for these people, it'd be amazing.
Yeah, if you send me all these questions, I promise one way or the other, I will answer them and send them back to you.
Fantastic. We'll collect them and do that. So thank you so much for being here today, for teaching us to choose ourselves. I appreciate it.
Thank you guys. Thanks for inviting me. I really appreciate it. Thank you.
Sure thing. And we are going to be moving on in our Own Your Future presentation. You've been great already. There's been so many questions coming through. Keep that going. Our next presenter is just the same. I am excited to introduce that next speaker. She is going to be taking us on a wild ride through the current state of the world that we are doing business within. She is the principal at the prestigious Boston Consulting Group and a lead member of their retail and large-scale change practices team, where she helps her clients harness big data to better serve consumers. She's an on and off entrepreneur in the food and beverage industry and an active angel investor. She holds an MBA from MIT Sloan School of Management, and perhaps most importantly, she's a certified sommelier. Now let's put our virtual hands together as we welcome Victoria Gutierrez to Own Your Future. Victoria.
Hey folks, thanks for that introduction. Let me just get my slides up here because I'm useless without them. All right, let's get that into presenter mode. So Ben, you gave all of the important parts. I think the one that I will also add in addition to kind of what I do with BCG and where I've been to school and the fact that I'm a wine nut is I am a proud dog mom to Peaches, the Italian Greyhound. I got her at the beginning of quarantine, so that's been kind of a great outcome for me out of all of this. But what are we gonna do today? The first thing I wanna do is we're gonna take a little bit of a trip in the Wayback Machine and look at what consumer sentiment actually looked like as this crisis was beginning to unfold. We'll then dig into the numbers of what actually happened from a behavior perspective as well as a spending perspective. So not only how were people feeling, but what did they actually do? And then we'll talk about, what are the sticky trends, what's actually gonna stay, and what do we think is gonna happen based upon what we've seen over the last 12 to 14 weeks or so. So jumping right in, if we go back to the beginning of early March, we did a survey with roughly 3,500 Americans across all different types of demographics and asked them, what comes to mind when you think about the virus? Some things that are not super surprising: death, fear, quarantine, China, overblown, kind of all the things you would expect. People were starting to see risk in travel. Death was top of mind for almost 1 out of 5 Americans. Most people believe the worst was still ahead, and actually most people thought that there was going to be a recession associated with the crisis. That being said, consumers were kind of throwing off some contradictory signals. On the one hand, there was big fear of the virus and some macro level fears. They were starting to think about reducing spend so that they could actually save, sock away some money, spend less on luxury, fashion, some of those more discretionary purchases. But there was also a sense of business as usual through the crisis. So people were still aspiring to those things we're always gonna say, like, I'm gonna eat better, I'm gonna eat more vegetables, I'm gonna eat organic, I'm gonna quit smoking, and do all those types of things. Yet roughly 80% of people still had not kind of changed their plans for how they were going to deal with shopping over the next months or so. So the expectation early on was that the winners were gonna be savings, eating better, doing more preventative health things, kind of preparing, spending more on education, whereas the expected losers were things that you definitely didn't need to spend money on, like toys, gambling, luxury, and fashion. But then of course, we were all stuck in our homes, working or not working for roughly 3 months. And want to take a look now at how did consumer sentiment actually change? Did people get more optimistic or more pessimistic? And what did they do? Did they actually change behaviors? Did they actually change spend? So these numbers are going to come from BCG's Center for Consumer Insights launched surveys at the beginning of the crisis and has done them for 14 weeks straight. We've also brought in spend data either from credit card data or other sources where possible to kind of get a sense for things. And most of the graphs I'm going to show you are from kind of where things were as of June 19th, so fairly recently. I'll start with the obvious. We've changed our activity dramatically. Of course, we're doing a lot less of things that require leaving the house. We're doing a lot more of wearing a mask, washing hands, new habits like cooking, anything on Zoom that can contribute to more and more Zoom fatigue, be it for work or connecting with family. And then the things that kind of net out even, some people are exercising more, some people are exercising less. And delivery and takeout was kind of flat. Some people were doing less of it because they were cooking more, some were doing more because they couldn't go to restaurants. So no big surprises here. Now, what happened was, as all that was happening, everyone saw China have one big, kind of peak and then flatten things out, France, we saw one big peak and flatten things out. We're looking at confirmed new cases over time here. And then the US, we saw we were able to flatten the curve, but not actually go down in trajectory, and we're starting to see an uptick again. And consumers are kind of concerned about catching the virus, more or less in relation to the shape of that curve. But it varies by activity type. So by far, people are most concerned about catching the virus from travel and tourism. They're fairly concerned about local activities, less concerned around at-home activities. And an Airbnb, for example, they're feeling that is much safer than going to a hotel or taking a flight. And going to the local stores, you know, for most consumers, they think that is safer than the Uber you may actually need to take to get to the store. Despite all those worries, people are still fairly buoyant in terms of their spend expectations. So these views are expectations of spending more or spending less in the coming months by month as the crisis has progressed. So on the left-hand side, you've got places where people have continued to think they're going to spend more. So they think they're going to spend more on restaurant pickup and delivery, that started to kind of level off. Still hoping to put away some savings, but then those things like spending more on fresh and organic foods, spending more on in-home entertainment, kind of, not super surprising. On the right-hand side, there are, negative spending expectations that are persisting for out-of-home entertainment in restaurants, despite the fact that, businesses were starting to open up in May and June. So people are still expecting to actually spend less than they used to in those areas. And, we're seeing fairly persistent pessimism in terms of expectations for spend in clothing, perhaps for spending more on tops, and we've killed pants and are just wearing pajamas. And things like cosmetics are also down as well. I want to take us through a couple of industries that have actually seen really, really big impacts. I'm going to start with US grocery. We've all been impacted in this. I have because I work with grocery clients, but we all have because we're suddenly needing to change how we actually get food. So what we did here is take a look at online grocery. The green dots represent what consumers, what percentage of consumers expected to actually increase their spending in online grocery. The gray line is the real year-over-year change in web traffic, and then the blue line is real year-over-year change in actual spend. And what was interesting here is while people were saying they were expecting to increase their spend in online grocery, you can really see that the change in web traffic was a really great indicator of people actually moving to that channel from a shopping perspective. So while web traffic has always been a great kind of leading indicator of changes in habits and spend, as things are moving quite quickly and people are reacting real time to the news cycle, it's actually been a great way to identify what's about to come. And what's been interesting is, a lot of that was an initial panic buy. People said, oh man, I need to stock up. I don't want to go to the store. So you got a huge, rush to people buying from Instacart, from Amazon Fresh, all those different things. What's interesting is some of the behaviors have actually persisted. Those, increase in basket or trip size has actually stayed while the frequency has dropped. So people are, holding on to this new stocking up behavior and actually thinking ahead about their purchases and maybe lumping multiple trips over the week into one trip or order, as opposed to, an ad hoc, oh, I was going to make a dish tonight and I forgot this one ingredients, I'm going to go to the store. No one's really doing that anymore. And of course, all this increased grocery spend has come at the expense of restaurants. On the left-hand side, you can see large chains have fared a little bit better than medium-sized restaurant chains. But on the right-hand side, when you break it out by format, what we're really seeing is anyone who had a pre-existing either expectation as well as capability around takeout or delivery has fared better. So, your quick service and fast casual have done better than the dine-in restaurants. And of course, your third-party aggregators like Grubhub and Uber Eats have, seen dramatic increases in sales kind of throughout all of this. One more that we've seen a big change in is the travel industry. So across airlines, cruise lines, hotels, they're all down 80 to 90% from a sales perspective year over year. And unique customers are down. What's interesting is the customers who are still buying are buying roughly the same amount of times as they were before. But whereas cruise lines have really, really had to decrease the cost of a cruise, Air tickets are roughly the same price they have been, and hotels have actually increased room prices. So people are actually willing to pay the same or more for their flights and hotels versus last year, despite just a much lower frequency or individuals actually taking part in those things. Now, if we look at automotive travel, of course, everyone's, the kind of darlings of the VC world have been the rideshare companies, and that's something that's seen a meteoric rise over the last few years. And even, heading into this year, still seeing a big increase in rideshare sales. Now, once the crisis hit, dramatic drops in rideshare, as well as in car rentals, and a shift back toward not only purchasing, but maintenance of, personal cars. Now, this is one where people are expecting to spend less on automobiles. It doesn't necessarily mean they're going to buy fewer automobiles. And this is going to be an interesting one to watch as we come out of this to see, are people going to go back to trusting sitting in a stranger's car or not? Last kind of deep dive on data I wanted to show you all is to look at non-food retail. And the big story here was anyone similar to restaurants, if there was a pre-existing at-scale option for e-commerce, and if people were comfortable with buying the item online prior to the crisis, you've had less of an impact. So if you look at off-price retailers, none of them have an e-commerce solution to really speak of, so they're more or less shut down, 100% down year over year. Whereas shoes, athleisure, lingerie, those types of things, not as impacted. And then if we break out accessories, glasses are barely down year over year, because you could argue that's actually not a it's not a discretionary purchase. So very interesting kind of range of impact seen across non-food retail. All right, so I've showed you a bunch of numbers, but the whole point is, what do we do now? How do we win? How do we actually plan for what the new normal is going to be? So we're going to take a forward-looking view of some research that was done. This is based on a BCG survey we did in mid-May. So I will say this does have a little bit of a lag, and it doesn't account for the recent spike we're seeing in the States. So take some of this with a grain of salt, but should give a sense for how consumers were thinking about coming out of the crisis. So first, to start with kind of a simple framework, on the x-axis here, you've got the long-term growth outlook prior to the outbreak for a number of different categories. On the y-axis, you can see what the short-term COVID impact has been. So in the top right, in the green boxes, categories that were growing fast, and they've accelerated that growth as a result of COVID. Amazon, online grocery, obviously, but then we're seeing some of those aspirational things. People are spending on OTC healthcare, organic and fresh foods, personal care. There's still a push towards all of this, and it's been accelerated. The loser, so to speak, we've talked about today, it's ride sharing, it's restaurants, it's anything out of the house. Kind of unexpected winner, and some of this has been retail electronics, where they were on a slow decline. They were expected to continue that decline, but now as we've needed to, kind of shore up our home office resources as well as buy electronics to keep ourselves entertained at home, it's actually seen quite an unexpected boost. And when you look across ages as well as income quartiles, overwhelmingly, people miss travel the most. That's what they miss the most. They miss getting out of the house, eating out of the house, some cosmetics. Kind of your older folks in higher incomes miss business travel quite a lot. Gambling ranks in the top 5. I guess people really, really want to get back to Vegas, but overwhelmingly it's leisure travel. And what's fascinating is that while 60 to 70% of people say they can't wait to start traveling again, less than 40% actually see themselves taking a vacation this year. So kind of their hopes and their excitement don't actually meet up with the actions they expect to take. And these kind of communicated sentiments actually tie with what we're starting to see around the globe. So on the left-hand side, you can see, again, that chart of China and France, how they've more or less gotten to a very, very low new case count. But, despite that, consumers are still saying overwhelmingly that their daily lifestyle is massively disrupted versus, pre-crisis. So France is only down to 70% from a 79% disruption at the peak. China only down to 62 versus 66. So people are not actually getting back to activity despite kind of having the right environment to do so. And they're actually still expecting to kind of pull back. So there's that expectation either of a second spike or of an extended recession. So people are still kind of, thinking they can't quite go back to normal yet. TBD on whether this happens in the States, but I think it's fair to say that we should all be expecting that the return to normal is going to be slower than originally thought. That being said, when surveyed, most American consumers want to return to normal in terms of levels for different activities that they're currently doing different amounts for. So they're doing less of shopping in stores today, and 66% of those people want to go back to their normal amount of doing that. Most people want to get to normal on in-home entertainment or cooking. They don't actually want to keep these new habits. This is truly temporary for most people. That being said, people who do want to keep their new habits are younger. So your Gen Z and millennial consumers are the ones who are saying, I've developed a new habit and I want to keep my new habit. So we're showing data here for an in-home entertainment activity. So you can see that 24% of younger consumers actually say they've developed a new in-home entertainment activity habit, and 22% of them want to actually maintain this new level. So they don't actually want to go back to normal. And this is fascinating because as that group of consumers kind of rises up in terms of amount of spend and amount of the total economy, we right now have an opportunity to shape their habits and actually create loyal, sticky customers who we're training to do different things right now because they're open to it. Now, if I take that and we look at the top 10 online categories, green dots are Gen Z and millennials we were just talking about. Blue dots are Gen X and baby boomers, and then all surveys response are the triangles here. In the first graph, you can see the percent of all consumers who made online purchases during the outbreak in these different categories. And on the right-hand side, it's first time ever. So you can see, not only are these people changing their habits and their frequency and buying in these categories, and the millennials may actually want to keep that new habit, but a lot of them are first-time buyers too. So there's huge potential here in this particular portion of consumers because they are actually taking on new habits that are going to stick. So if I sum it all up, we have two normals, right? We have the temporary normal, which we're all living in right now. Leisure travel and out-of-home entertainment are basically done. We're wearing masks, and some of us are actually exercising a bit more. If we think about those things, those are likely to revert more to the old normal. It will take more time than we expect, particularly for leisure travel and out-of-home entertainment, but we're going to stop wearing masks. We're going to say this is a new workout regimen, but it's going to be just like any New Year's resolution. We're going to go back to normal on it. Now, the things that are going to be part of the new normal, it's going to stick. Some of the things we're doing less of, we're probably going to keep doing less of. Work travel is one, and I think this is going to come from both employers and employees. We're just going to stop traveling. I used to spend 50 weeks out of the year on the road, 4 days a week. I have not traveled in 5 months, and I can still do my job. I think a lot of different industries are starting to realize this. So it will be unlikely that we get to a totally normal level on work travel. Similar with eating at restaurants and shopping in stores, these could be potentially dampened if people, continue to think it's a less safe alternative, or it's just so much easier to buy things online. That being said, there is going to be an opportunity to actually grow overall demand here. We're just going to need to kind of change the offer. Some of the things we're doing more of that, will likely stick: washing hands and cooking. These are good habits. Those are things that people are probably going to keep doing. Working from home, probably not as much as we're doing right now, but that's going to stick as well. And kind of all of the things that come along with that, like having home office setups, having reliable internet, being on Zoom, all of those types of things. And then there's a whole host of things that were pre-crisis trends that actually have accelerated during this, and there's an opportunity to capitalize on that growth. So online shopping, obviously, everything's moving online. Video chat, having virtual classes for fun, learning different things online, social media in general, delivery and takeout. Those are the types of things that there's actually a big opportunity because we've seen the capacity for people to switch to these things, and we can capitalize it with kind of longer term to create the right solutions and the right offers for people. 6 takeaways for you all from tons and tons of numbers I want to leave you with. One is it's right to be thinking about and planning for post-crisis behaviors. It's the right thing to do, but we need to expect there's going to be a bigger lag, to get to new normal than we expected. We're going to be in temporary normal, likely longer than we want or expect. A lot of the changes, particularly the huge declines we've seen in certain categories, are more likely to be temporary. Travel's going to come back. It's down 90%. It'll be back. We want it to be back. It just might take longer. Third, now more than ever, watch web traffic as a leading indicator of change. It's always been a great way to kind of anticipate shifts in consumer sentiment and consumer demand. But right now, as things move quickly, keep doing it if you're in an industry where that actually can help. We talked about this a fair bit, but change is sticky with younger consumers, and they're signaling that they're making new habits now that they want to stick. So you have a chance right now to actually create loyalty with these folks as they're kind of rising up in terms of socioeconomic status. Pre-crisis growth in health and wellness, the aspirational things to eat healthier, be healthier, it was growing pre-crisis, it accelerated in the crisis. There's a huge opportunity here because people are spending time with themselves and wanting to invest in themselves and their well-being. And then lastly, if I were to sum up where the likely winners are going to be kind of heading out of the crisis, me around, to the extent that you can enable working from home in the many different ways that you can do that to make it easier, to make it more convenient, to make the home setting work better for this. Distance learning of new skills, be it, cooking. I just invested in, classes to try and make my sourdough bread suck a little bit less. A lot of people are, learning a whole bunch of new things, music classes, all of that. So being able to teach people online, it's going to be huge. Anything for social interaction. We've got, grandparents learning how to use Zoom for the first time. That's exciting. So what else can we do to actually enable social interaction and keep, all of these new interactions that aren't in person going? And then last mile delivery, as more and more gets to kind of moving online, as we, we're buying everything online, how can we actually enable that in a way that is scalable and makes sense? There's going to be some winners and some losers there. Thank you all for listening. It was a lot of data. This is my email address. Feel free to shoot me a note if you have a specific question. I know there's a whole bunch of folks from a lot of different industries. And I'm happy to kind of, jump in where I can, because this was a pretty high level overview of kind of what BCG's seen over the course of the last 14 weeks.
Yeah, it's really fantastic. My God, the amount of information there is mind blowing. Hold on, I'm just going to turn off your screen share there so we can appreciate each other in this new virtual world that we are living in. So again, thank you. We have a few cool questions come in. One that I'm really intrigued by is if you have any insight on if people during this time have kind of become more trusting of tech, or if it's all just been a function of necessity and it'll kind of disappear after that.
That's an interesting one, and I don't have a fact-based or data-informed answer.
Of course, there's not a lot of data to that, I don't think. But just based off of your insights, what's your gut telling you?
Based on the insights, people are being forced to do things that they probably should have been doing all along, or that, it requires breaking bad habits, and this has been a clean break. It's kind of gone cold turkey for some people. So to the extent that we've all had to move to video conferencing and Slack and all of that, and nothing catastrophic has happened, I have to expect that that's created a lot of trust and goodwill in tech in general.
Yeah, for sure. It is interesting. One thing that, and this is kind of a question for myself, and I'll get to a couple others, but one thing I've noticed between just personal data, myself and my friends, is we're all kind of saving a lot of money right now, because I'm not going to restaurants and I'm not spending money on a glass of wine or something like that. Do you guys see there's going to be like this huge boom at some point when people's kind of like they're kind of accumulating all this wealth and all of a sudden they're going to not know what to do with it?
Yeah, that's an interesting one, because it requires peering into the crystal ball a little bit and saying, are we going to have a massive impact on the economy or not? If not, Maybe this enables people to be first-time home buyers. Maybe it means paying down a bunch of debt. There's a whole, host of different ways people could actually, change their spending habits and, their total, kind of economic health with that. Whereas if, we have a second, third spike, if we go back into massive layoffs, if, there's an extended recession, then people are going to need, all those extra savings to actually get us through all of this.
Yeah, for sure. This one, I think it's just kind of a recap here. Someone was asking what were some of those key indicators you mentioned on how the market's doing? Can you expand a little bit on that?
Consumer sentiment is one thing, but we all know that we don't always do what we say we're going to do. The best kind of indicator, at least through this and historically when there have been big shifts, is to just watch web traffic. Simple things like watch search traffic for particular words, look at web traffic for a group of websites that are in a particular industry. Increases usually predict future activity. So that's kind of been the big kind of unlock for us as we watched. People said they were going to buy more online, people started researching more online, and then you saw the money actually come.
Got it. So it's kind of like this staged out process.
Yeah.
Makes sense. It's funny. There's a question here from someone who I'm assuming owns a website or a business in the home and garden niche, and they're kind of wondering, what do you think the outlook is in that industry? I mean, I guess as people are staying home, are they investing more in how beautiful their backyard is?
Yeah, so I've had a few conversations with folks in the real estate industry, as well as I've had some DIY retailer clients in the past, and talking to them, they're seeing huge booms. People all of a sudden are realizing not only that they're spending more time at home, but they may be spending more time at home more long-term. And, they need to make it, a place that is more multifunctional than it used to be. Needing to make sure that you actually create an office space, making a beautiful garden to walk around in when you're on the phone, those types of things. People are reinvesting a lot in their homes, both in the real estate itself, as well as kind of the look and feel of their homes, because all of a sudden we're spending way more time than we used to in them.
Right, for sure. We only have a minute or two here left, so I'll thank you first before I kick you off the internet. But I thought this was a good question to end it with from Sanjeev. It's a great one. He says, if you were to enter one business space after viewing all this data, what would that be? We'll pretend money is limitless and the world's your oyster.
Money's limitless. I am buying a massive fleet of electric powered trucks, and I'm just making deliveries.
I like it. You can combining several industries there. Probably why Tesla's stock has been going through the roof.
Yeah.
Amazing stuff. Well, thank you again, Victoria. I love seeing that much data. I'm going to flip through your deck again myself, just so I can take it all in, because it's so much. So thank you for being here. And I'll say goodbye for now. We'll get excited for the next one. Cheers. All right, guys. Well, thank you so much for sticking around. I know it has been quite a day, a morning, an afternoon, whatever it is, wherever time zone you're at. I'm excited for our next guest. It's gonna be a little bit different. We're doing a fireside chat without the fire, but still the chat between our CEO here at Flippa, Blake Hutchison, and a gentleman named Sieva Kozinski. Sieva is an entrepreneur and an investor. He's raised over $10 million in venture capital and has scaled his business to tens of millions of users. Today, he is the co-founder of a company called Enduring Ventures, which buys beautiful businesses and holds them forever. And I was looking at his LinkedIn, and one thing I love is that he also says he loves houseplants. So that's a nice touch. Now let's put our virtual hands together for both Sieva and Blake, if I can bring him in here. There you go. Hey guys, how you going?
Howdy.
Hey, Sieva, thank you so much for joining us on Own Your Future, and thank you, Ben, for the introduction. Sieva, it's 4:21 a.m. right here in Melbourne, Australia. What about you? Where are you right now?
Wow. Well, you're in the future. Hopefully you can tell me what it looks like.
It's dark.
I'm in California, San Francisco, so almost other side of the world. It's 11:21 a.m.
Okay, fantastic. And thank you very much for joining. I do want to start by just asking people to check out enduringventures.com. The site boldly states, we buy exceptional businesses and hold them forever. And of course, you're not only the co-founder of Enduring Ventures, but you've got a very, very strong background in entrepreneurship. And so perhaps we could just start by talking about your entrepreneurship journey before Enduring Ventures, because I think for a lot of people online right now, and for those people who are listening to a recording of this, there's a journey between entrepreneur and investor, right? And it's so many people who go from entrepreneurship to investing. Now, you were once upon a time on the Forbes 30 under 30 list for an education startup. So tell us a little bit about your entrepreneurship journey and actually what happened to that business.
Yeah, sure. Happy to give you a little bit of background to kind of color who I am and how I ended up running Enduring Ventures. So I grew up in the San Francisco Bay Area, so I was largely surrounded by tech. My family is from the Soviet Union, so we came over when I was pretty young. I have a family full of dentists and doctors, so growing up, never really considered entrepreneurship as a path. It's not something that I really heard about. In the Soviet Union, people didn't own their own businesses. Everybody just worked for the government. So I didn't know that was an option. I always thought I was going to be a doctor or a veterinarian. So when I went to college, I studied pre-med, very much planning to go down the doctor path. In college, I took an entrepreneurship class, and it was with this professor he built a business from scratch. He'd sold it for over $100 million. And I remember he was like so cool. He was the only professor that would come to class every day wearing a Hawaiian shirt. And he was very much not the classic academic, buttoned up, glasses and so on that you would imagine. He was very cool. He's very laid back. He'd swear in class if he wanted to. And you could tell that this guy had kind of made his own world and pursued his own destiny. And he was just confident in who he was. And it was it was a very magnetic energy. So I really enjoyed that. He opened my eyes to entrepreneurship. He would invite his friends who had also built companies, who'd raised funding, who'd sold companies. And it was really the first time in my academic journey that I was like really hooked on something. I was like, man, this is amazing. I love this. I don't know how I'm going to get into it, but I would like to explore this as a pathway for my career. So I dropped medicine, much to my parents' dismay, and went down the path of tinkering with startups and built a couple of different companies early on. My first company in college was basically a tutoring business. I think it's pretty common for college students to see that, there's some students that need help. There's other students that can help them to connect the dots and to start generating revenue. And that's basically what I did. I expanded from there, got together with a partner, and we basically built this website where we would go to students in class. We would find the best student note takers in that class. They would post their materials on our website, and then their classmates or students from other schools could buy their class notes or their class study guides. And that business really took off. It was called Study Soup at the time. We grew it from just my campus to about 300 campuses nationwide throughout the US and Canada as well. And it really became this resource where if you were a student who was struggling in school, you could go to this website, you could get tutoring help, you could get class notes, you could get class study guides, all made by people on your campus or some of the best students in your classes. So I ran that business for about 7 years. We'd raised a couple $1 million in venture capital, grew it to about 1 million to 2 million students using our products every month. So it was a really fun journey. I learned a lot. I made a lot of mistakes for sure, but was really fortunate to hire a great team there. And that is actually the team that runs that business today. So I left the business 3-4 years ago. I'd always wanted to go out and build other companies. I'd wanted to test my hand at investing and other startups. So that was a conversation that me and my co-founder had pretty early on in the business. and he knew that I was going to go off at some point, and he wanted to stay with the business and keep running it. So I still own that business, and it's still doing well. It's still growing, but I've been working on other projects ever since. And
fantastic.
Some of
And
those
there's quite a few businesses in that space as well now. Like you obviously started that early, but that's a concept, and obviously online learning and education is thriving right now.
Yeah, definitely. It's been booming. When I was in it, it was a little fringe and a little niche, and it was debatable whether people would ever do online learning or whether you really needed people to go into class. I think companies like Coursera at the time they came out the doors firing. They were really exciting for people. They raised a bunch of capital. And then there was a long period of time where all of these ed tech companies were the ugly duckling in the room, right? They were not proven. There weren't enough users using them. But I think now in the last 3 to 5 years, all of those companies are starting to do really, really, really well. So fortunately, ed tech is having its comeback moment, especially in times like this where you don't have the option to go to class, right? So now digital learning, online learning is the only option. So those companies are doing really, really well.
Yeah, I mean that's outstanding experience, and I think that there's so many people right now who are students who would never have imagined that they would do something online and learn online and engage with a teacher or a lecturer or a professor, and that's now obviously happening at feverish rates. How do you think that being an entrepreneur has prepared you to be an investor, someone who wants to buy businesses actively and regularly? Do you think that being an entrepreneur, someone who's created an online business from scratch, gives you a unique, I guess, position to take?
Yeah, I really do. I think there's a few different reasons I was an entrepreneur first and now an investor. And I still consider myself an entrepreneur in many different ways. And I'll explain that. When I was starting my business in college, I was just like a kid that knew nothing about business. And I was not at that stage or at that age, I wasn't at a stage where people would trust me with their money to do investments, right? I had no track record. I had no experience. So building my own company was really my own way of building up my reputation, building up my knowledge of how to hire, how to scale a team, how to train a team, how to find product market fit, how to scale the business, et cetera, and how to really like extract a profit, right? So that experience of running the business for 5, 6, 7 years really taught me a lot of the skills and a lot of the insights that I use today when I'm assessing a business. I think if you ran your own business, you can connect with founders at a deeper level. And I will caveat and say that I know a lot of great investors, both VC investors and private equity investors that have never ran their own business. So it's not a requirement, but as you can imagine, if you've ever built your own house or if you've ever done your own construction work, then when you plan to build your house down the line and hire a contracting crew, you speak the same language, some of the intricacies, you can kind of, if there's some conning going on or some misunderstandings, or maybe somebody's trying to get around you, you can really see through that because you have that type of personal experience. So given that, like today, when we're looking at businesses, I'm looking at dozens, sometimes, over 50 businesses a week. And because of my experience of running my own company and understanding, what are the staff structures that are needed? What are the normal cost structures? What are some opportunities for this business if it were to be 5 times the size and if we were to help grow it? I've seen that path before, and I can apply some of that wisdom to the businesses that I'm looking at. Even if it's not the same business model, even if it's not even in the same industry, what I've found is business is kind of a universal skill. And, you can build up your chops or your education through building your own company in an education business. You can build your own, pool cleaning company, and you can take those fundamental building blocks and apply them to almost every other business. Even super big, super complicated businesses, once you break it down, it's all the same fundamentals. So I do think it's super helpful in that sense.
It's a super interesting point, and we see this a lot play out on our platform. Even if it's a smaller micro asset, let's say it's an e-commerce business, let's say it's making $50,000 a year, the seller doesn't want to have to spend the time educating someone who is completely new to e-commerce. And so they don't want to have to deal necessarily with, hundreds of questions about how e-commerce works versus how the business operates. And so we often see sellers say to buyers, hey, do you actually have experience in e-commerce? It sounds like you're interested in buying my asset, but you're asking questions which would assume that I'm going to have to take you on a bit of a journey as to how e-commerce functions versus how my business functions. And so I think that it's like a marriage, and be it in the domain that you operate, looking at bigger businesses, or in the domain that we operate, looking at smaller businesses, that knowledge and subject matter expertise counts for a lot, and is going to help through not only browsing for businesses, but actually through the due diligence and negotiation period.
Yeah, I definitely agree with that.
So, Sieva, tell us a little bit about Enduring Ventures. So you've got this statement. It's a holding company inspired by Berkshire Hathaway. So let's start there first. What do you mean by that, and what does Enduring Ventures try to achieve?
Yeah, so I think one thing to understand is that Enduring Ventures, or the idea for Enduring Ventures, came out of me and my co-founder's desire to build something for the long term. When I first started my startup right out of college, I had this mentality, and I think it's a mentality that many entrepreneurs share, of I'm going to run a project for 3 to 5 years. It's going to grow super big. I'm going to get wealthy. My investors are going to get wealthy, and then I'll move on and work on something else. And I think that short-termism, that mindset is very common. And one thing that we wanted to do when we were approaching this is we wanted to really think about, well, what does a business look like if we're going to run something for 15, 20 or more years? And I think it's pretty rare for people to think in that way. And, if you follow any of Charlie Munger's or Warren Buffett's methodologies, you'll know that incentives drive everything in society. Incentives drive your behavior, incentives drive outcome, incentives drive how you run your company. And, by setting a 3 to 5 year mindset for myself in the past, I was creating incentives that would encourage fast growth in short periods of time. And if you think about it from the other perspective, you'd think about what are some of the downsides of optimizing around fast growth in a short period of time. And that may look like, it's not applicable to all companies, but many companies that we see today that raise VC funding and are looking to do that huge growth to hundreds of millions or billions of dollars in valuation in 3 to 5 to 7 years, they are sometimes pursuing what is an unsustainable business model. Sometimes they're not supporting their employees for the long term. They're really looking for people that can create huge growth in a short period of time, and then so they can move on to other people. And sometimes we see great outcomes like Airbnb or Uber maybe, but oftentimes, if you guys read TechCrunch, for example, you'll see the company that raised $40 million and disappeared in 2 years. And we see that, I think, every few months. And I think that's largely driven, these aren't horrible businesses, right? That's just largely driven by taking a business that could be a good, slow growth business and trying to apply venture capital jet fuel to it. So we are the anti-VC, the anti-private equity group. We got together to really think about this longer term idea and have pulled a lot of our inspiration from Berkshire Hathaway, as you mentioned. And I'd say, if you study Warren Buffett's career, which we have quite a bit, I'm a big biography nerd, first of all. I'm a big Warren Buffett nerd, second of all. And if you studied his career, you know that, he had what I call kind of 3 major turning points. He had his first life as an investor, which was following his mentor's style of investing. Benjamin Graham came up with a book called The Intelligent Investor. He was his professor at Columbia. And his whole methodology of investing was a simple, very simple framework. You analyze a company's financials and their assets. And as long as those two things combined together are worth more than the market cap of the company in the public stocks, then you invest. And as long as you keep investing in what he used to call these cigarette butts, those will grow in value. So that was the first life of Warren Buffett. Then as he started raising funds, he started looking more towards companies that he could acquire majority or a complete stake. And one of the companies that stands out that we know him for is Berkshire Hathaway. So Berkshire Hathaway was a textile mill that he bought that at the time was throwing off anywhere between $3 to $5 million of cash flow. And first he bought a small piece, and eventually over time he bought the whole company. And what he learned from that company was that, because it was a textile mill, and as you know, history has already played out, most textile manufacturing has gone overseas. So there was no amount of investing that he could do in Berkshire Hathaway to make it more competitive. The trend was everything was moving overseas. So what he learned there was that he could take that about $4 million of cash flow every year, and instead of reinvesting it in the textile mill, he could apply it to other businesses and then create multiple entities that were all generating cash flow that he could then use to reinvest in the best businesses. So that was kind of his second big learning from my perspective. And then I'd say his third one was when he met Charlie Munger. And Charlie Munger's philosophy was a little bit different. He was against the cigarette butt methodology. He more so wanted to invest in great businesses with great brands that he felt would create a ton of value in the future. And slowly his influence kind of wore off on Warren Buffett. And that's how Warren Buffett started investing in companies like See's Candies and Coca-Cola and Geico, American Express, all of these companies that had at the time really strong brands. Of course, they were a lot smaller than they are today, but he got into these perpetual motion machines with a moat, and they just grew and created a ton of value for Berkshire Hathaway. And those are kind of, those last two principles are the ones that we really take from Enduring Ventures, is how do we use cash flow to create compounding value over a long period of time? And how do we identify businesses with real moats and real brands that we can get involved with for the long term, right? For 15, 20 or more years.
And so that's the hard thing, right? Finding a business that has a moat in the first place. And then, once you do, how do you find a pathway to owning enough of that business to be able to actually control decision-making and hold on to it forever? So how do you think about that? In the case of Berkshire Hathaway, I understand that there's, kind of 5 macro groups. There's this area of their portfolio where they aim to own the entirety of a business, at least 80% of a business. Presumably that's what Enduring Ventures does as well. But how do you even find yourself in that position in the first place? It's a great aspirational goal, but to find a business that has a moat and then to find yourself with a overwhelming ownership of that business is not trivial.
Yeah, it definitely isn't. But I think, again, this plays into this mindset of short-termism versus long-term mindset. We are very patient investors. We can look at hundreds and hundreds of businesses and decide not to pursue them. I think over the time me and Xavier have been running businesses, we've developed a good eye for what are the things that we're looking for in a business. So when we look at 100 companies, we can spend, maybe 10, 15, 20 minutes on them and then pick out just the 2 or 3 that we want to go deeper on. And another Warren Buffett phrase or a piece of knowledge to share with you guys is he said, investing is like baseball, except for you never strike out. You don't ever have to strike out, right? You can just wait for the perfect pitch. So in baseball, you'll get 3 pitches and then you have to go. You get 3 strikes and then you have to go. But in investing, you can just stand there at the plate all day and wait for the perfect pitch to just come right at you. And that's the one you can swing at and really knock out of the park. And that's how we think about our investments too. There's a lot of competition out there. There's a lot of private equity funds or private investors, but we have a little bit of a different lens. We're not looking to grow a business for 4 or 5 years and flip it. And also we're willing to wait and apply some of the skills that we've built running our own companies in order to nurture growth out of something that otherwise wouldn't be the best fit for someone like a private equity fund.
So you've been doing this for a while now, and we've got lots of buyers who are listening in, and that's part of what Own Your Future is, either those people starting something or those people acquiring something, and there's a few people obviously considering selling. Let's say you're a new buyer and you're looking at acquiring your first business. You've been doing this for some time. What would be a couple of tips that you might give a first-time buyer?
There's a few things that I can kind of rattle off here just on the fly. I think the first thing to understand is, the first thing that's really important to understand is yourself, right? Who are you and what are you looking for? Everybody has a little bit of a different personal profile going into buying a business, and everybody has a different ideal outcome. Some people are looking to run 2, 3, 4 businesses. Some people just want to buy one business where they're a full-time operator, and others just want to buy a business, but they don't want to operate it at all. So I think understanding your skill set, are you able to run this kind of business? And if not, are there people in the company, or who can you hire to run this business? And remembering that hiring great people is really, really hard. So if you find a business and you don't feel like you have the personal skill set for it, just make sure that it's going to be really hard to hire someone to lead that business. So take your time with it, or maybe look for something that could be a better fit for your personal skill set, or one that you can personally run. So that's the first thing, is really try to understand yourself. The second law that we strongly believe in at Enduring Ventures is Newton's first law, which is objects that are in motion stay in motion. So if you're looking at a business that's decreasing in revenue or decreasing in user base, the most likely scenario, unless you can pull a magic trick or you have a very specific set of experiences to turn that thing around, the most likely scenario is that it'll keep going down. Now, if a business is growing 10 or 20% per year, and it's been around for a few years, and it's going up like this, then Newton's first law says that it is much more likely to keep going up like that. So if you're a first-time entrepreneur, especially if you're a first-time entrepreneur or first-time buyer, I would look for businesses that have a consistent pattern of growing, or it doesn't have to be even growing fast, but of growing and growing over a period of time. And the reason I say period of time is because people can simulate growth for 6 months, for a year, sometimes for 2 years. But if you're looking at a business that's been around for 3 years or more, and it's been on a consistent growth pattern, then it's much more likely that even you, somebody who's new to the business, doesn't understand the industry, will come in and it'll continue to either grow, or maybe it'll flatline, or maybe it'll decrease a little bit. But it's much easier than if you come in and the business is already decreasing. So those are some of the kind of obvious things that come to mind. But if you guys have specific questions, if there's listeners that are looking at buying a business, you can tweet at me. You can DM me and we can talk about your specific business. And I'm happy to advise anyone and just provide kind of a sounding board for your decision making. Sometimes it can save you a lot of time and money.
Yeah, outstanding, Sheva. Thank you so much. That's very generous of you. So down to practicalities for a moment. How many businesses have you acquired, or has Enduring Ventures acquired, and what are the acquisition plans moving forward?
Yeah, so, our goal is to acquire probably 3 to 5 businesses a year for these first couple of years. We just made our first acquisition in February, so we've been around for about 9 months or so. We raised a little fund from essentially friends and family, people that trust us, to go out and acquire these businesses. Our first acquisition, so we've had 3 companies that we've bought. two of them that we haven't announced yet. They just got acquired in the last 30 days. And one of them that we did announce, and that you guys can actually research online, it's called upcounsel.com. And UpCounsel was an interesting business. I had used UpCounsel in my previous business. So what UpCounsel does is it helps businesses find affordable attorneys. And in my last company, I had a really, really expensive attorney with a brand name firm, and they were charging me like thousands and thousands of dollars every time I wanted to meet with them. It was so expensive. It was driving me nuts.
Yeah.
So I Googled, yeah, you probably know from running your business. So I Googled around and I found this company called UpCounsel, and it was basically a resource, kind of like a very specific Yelp, but for attorneys that work with businesses and that address the needs that I needed. And I found a great attorney there, and she was a third of the cost that it was costing me for my attorney. And I ended up hiring her for this project, and she became our in-house general counsel. She would help us on all of our paperwork or legal needs for about 5-6 years. So it was great. And about a year ago, or maybe I guess this was 6 months ago, I got an email from the UpCounsel CEO and CTO. It was just a generic email. I was just getting it as one of the users, and they were saying, hey guys, like, it's been a good run, but unfortunately we're running out of capital and we have to shut this business down.
Yep.
Yeah. And that was really shocking to me because, I'd used it a ton. I'd spent a lot of money on the platform. I had recommended it to so many of my friends. They'd used it. I'd heard a lot of great things about it. And when we dug into it, they'd raised over $20 million for the business. And it was one of those cases where they were trying to build a huge venture scale business, which is understandable. And that's why they raised so much money. And they built a really great business with a great brand, with great revenue, with great lawyers. But unfortunately, they hadn't achieved that, what we call escape velocity in venture capital. They weren't going to become the next Airbnb. They weren't going to become the next Lyft. And because of that, and a couple of kind of legal issues that came up, their investors got cold feet and they weren't able to continue fundraising and growing the business. So I had thought that the business was going to be too expensive for us, to be totally candid at the time. My business partner had the foresight to reach out and just kind of learn a little bit about the situation and see if there's a way for us to keep this business alive, because we knew, thousands of businesses were using it to hire their lawyers. Fortunately, by the time we got there, I think the investors had mostly written it off, and the CEO and the CTO, unfortunately, were diluted quite a bit through that journey. So we were able to come in and acquire the business at a reasonable rate, and they were really just happy to see this thing that they'd created for like 8 years, 9 years, stay alive. They were pretty sad to see it go. They were happy to see us come in and run the business for them. So that's a little bit about the UpCounsel story. And then as far as where we're heading next, we're looking at, I think maybe 4 or 5 different B2B SaaS companies. We're also looking at local service companies. So we have this two-sided strategy. It's basically a barbell. On one side, we look at sleepy service companies and sleepy software businesses. So they generate a good profit. They've been around for a really long time. They have some kind of moat or monopoly in their area, maybe a local monopoly or maybe a brand. And on the other side, we look at these tech companies like UpCounsel, companies that are great businesses with a great brand and good revenue, have maybe raised a little bit too much money, and we can come in and help them keep the business alive, maybe restructure it in some ways and put in a team that can run it profitably.
So firstly, super surprised to see the UpCounsel acquisition, know the UpCounsel business, and obviously, as you said, venture-backed, and found itself to some outstanding clients, both enterprise, startup, and very, very strong brand name small business clients. And so when you see something like that play out, you immediately question what has played out there. But as you said, the VC landscape doesn't necessarily reward some of those businesses which aren't rocket ship, fast growth, versus your approach, which obviously is looking for those businesses which can be enduring and continue to spit out cash flow. Just quickly, you talk about acquiring businesses with a moat. What do you define as UpCouncil's moat?
Yeah, good question. UpCouncil had a couple of pretty obvious moats. Seeing as they've been around for 8+ years, they are recognized as one of the top legal search sites in the tech community. If you ask, 10 different folks in tech, VCs or entrepreneurs, most of them have either heard of UpCouncil or have used UpCouncil and had a good experience in the past. And we learned that by just doing some simple due diligence when we were considering buying the business. We'd ask around of CEOs and see who used it before. And that was the feedback we got. So that was really exciting for us. The other moat that they have, which is something, again, they've built up over 8 years, is they have this treasure chest of legal content. They've created tens and tens of thousands of pages of super high quality legal content. And oftentimes either lawyers or businesses that are searching basic legal questions end up on UpCouncil on one of their blogs or one of their free legal documents. And then oftentimes, some of those folks will basically go and book a job and ask to speak to one of the lawyers. So there's over 1 million people a month that are coming to this website that are high quality business leads that are then funneling into this process of booking a lawyer. And that's another moat. It's really hard to build. They built a really strong online brand, SEO reputation. And it's not something that somebody could just come in overnight and unseed, right? As long as we keep creating content and we keep creating value for customers, that entity or that value is just going to keep growing.
Okay, that's super interesting. I think that provides some outstanding context for our buyers listening in who are thinking about how they assess opportunities. Can we talk a little bit about how you assess value? So obviously, a seller of a business, a founder of a business will ascribe some value to their business. They often think it's worth more than you might think it's worth. So let's talk a little bit about buyer and investor philosophy in that regard. Typically, we would always say that a buyer pays for performance but looks for opportunity. And a seller often wants to sell and get a valuation on the basis of opportunity and not necessarily historical performance. So how do you assess value? And then secondly, how do you trade off current performance versus long-term opportunity?
Yeah, that's the age-old question. When it comes down to the buying table, usually the way we'll approach it is we'll learn a little bit about the business, and I encourage other sellers to do the same, and then ask the seller what they think the value of the company is, right? Because at the very least, that'll help you understand, are there expectations within the realm of reality, or are they way too expensive for what you're looking to do? I think, and I've been in this position as well as a founder. I think as a founder, you get really emotionally attached to your business and you think it's the best thing since sliced bread. You've been working on this thing for 5 to 10 years and you think it's worth a ton of money. You've seen, and some of this is dictated by the tech environment where you see, a software company in the public markets getting 30 times revenue or 1,000 times revenue, if you're looking at Zoom. So given the expectations of the seller, if they are starting so high, if they want 10 times revenue and you're actually valuing them on a profit margin and you want to pay, 5 or 10 times profit, then you are likely way too far away from each other to get there. So what you can do at that point is you can just propose your price, but what's most likely to happen is you're going to need to move on. For us, we value businesses on profit. Or most of the businesses that we look at, we value on profit. And that's on this side of our barbell. Remember the sleepy companies, the software companies, the sleepy service ones. Those are all profit-based companies. They've been run by the owners for 10, 15, 20 years, and they've been generating some margin of profit. And we'll basically take that profit, or we usually use EBITDA specifically, which is earnings before interest, tax, depreciation, and amortization. and we'll apply a multiple that we think is reasonable for that industry, right? If it's a local service business, maybe it's something between 3 to 6 times EBITDA. If it's a software company or tech company that's been growing, it could be more. But those are some of the ranges that we look for. Obviously, for something like Up Counsel, where this was a VC-backed business that wasn't profitable, they just had revenue but no EBITDA. We had to come in and be a little bit more creative. And to your point, Blake, we had to look at what was the future opportunity of this business, and could we structure a deal, a financial deal, in such a way that it would allow us the opportunity to chase that bigger opportunity without losing our pants if it didn't work out, right? Because when you're chasing an opportunity, you're taking a huge risk, right? As opposed to if you're taking a business that's already doing something, it's creating a profit, and as long as it keeps providing that service and supporting customers, it'll keep creating the profit. There's less risk there than if you have to come into a business and maybe change the business model or change out the entire team. So I would just adjust for that accordingly, and you adjust for that in your price.
Awesome insight, fantastic insight. Thank you so much. I've got one more question, and then I'm going to take a question from the group. Stating the really obvious, the current climate has changed, but how has that changed the way you think about investment opportunities, if at all?
Yeah, it's a good question, and it's something that everyone should be thinking about, of course. I'd say most of the businesses that we've been looking at, fortunately, have not been hit by COVID. A couple of them have. Some of them have actually been growing because of COVID. And that creates a tricky situation from both sides, right? Because now we have a business that's growing fast during COVID, and maybe the owner expects a valuation based on their COVID revenue, but we don't know how long this thing is going to last, and we don't know whether these are just short-term revenues. So we're starting to have those conversations around, how do we price in this bump without changing the initial kind of expectations too much. On the other side, of course, there's businesses that have been totally shuttered by COVID, or some have just been hurt. Even Up Counsel saw a decrease of, maybe 30+% of people booking legal help, right? Especially in that first month or two, businesses were just fighting fires, just trying to deal with employees and keep the lights on. So normal kind of legal processes just weren't happening. We're seeing that bounce back now. Fortunately, it was a scary couple months for us. But that was the case. So for us, we are definitely expecting COVID to be around, this COVID situation or reality to be around for a long period of time. So any business that has been meaningfully disrupted for the last 4 months because of it, we are unlikely to purchase or unlikely to pursue, unfortunately. But any business that maybe took a hit in the first couple of months and now they've recovered, we're definitely still looking at. And then the ones that have increased in value because of COVID, we're also really interested in. So I would just think about those things. There's certain products, there's certain softwares that are likely to do well in this new work from home reality. Your last speaker spoke about this. I think she's totally right. I think people are going to be less likely to travel for work. I think people are going to be less likely to travel for school. Even folks that maybe were in an older generation and doing investment banking or deals or whatever it may be that were averse to Zoom or video chat before have quickly adapted to this new reality. And I think they're realizing that now they can hang out at their vacation home in the Hamptons and also do all of their business, and they don't have to fly across the country. So it is our new reality. I don't think it's going anywhere. So just keep that in mind when you're buying your businesses, right? Think to yourself, what does the new world look like? And it's certainly not what the last world looks like, and adapt accordingly, because we certainly are.
Yeah, absolutely. The short-term versus long-term dynamic is pretty complex to get a read on right now. A final question, and probably because there's lots of business owners listening in on the line, just give everyone a reminder, or maybe we haven't covered it at all. What size of acquisitions does Enduring Ventures actually look at?
I would say we have a sweet spot, and then we'll look at deals larger than that. So I'd say our sweet spot is in the $1 to $10 million of revenue range, or maybe 500K to $3 to $4 million in profit. We partner with some investors, so we are looking at deals that are larger than that. And there are a couple of instances where deals that are smaller than that, for example, like widgets or apps or Shopify apps, that are doing pretty well. They're growing and they're certainly stable, but are maybe smaller than the $1 to $2 million revenue range. We're also looking at those as well, but really trying to stay in that sweet spot of 2 to 10 million in revenue.
Got it. Well, Sieva, thank you so much for your time. Thank you for being a part of Own Your Future. Really outstanding insight, and really appreciate all of your time today. Thanks again.
Yeah, my pleasure. And if any of the attendees want to give me a shout, feel free to hit me up on Twitter. I just shared my handle. It's just at Sieva Kaczynski. Happy to chime in and provide some feedback on any businesses that you're looking to buy or sell. I think this stuff is super fun. I'm a big business nerd, so I'm always happy to chat about it. And thanks, guys, for putting on the panel.
All right. And we're back. Just enough time to refill my coffee. As mentioned, it's been quite a day so far. Hopefully you guys are enjoying yourselves. I do appreciate you sticking around for this marathon of information, education, inspiration, other sort of shuns. The next presenter, we're definitely going to do some Q&A. So use the button at the bottom of the Zoom panel to get those in, and we'll filter them through for you. I'm really excited for our next presenter. He's a fellow Austonian here in Austin, Texas. According to his LinkedIn bio, he likes to make things and eat tacos. He considers his specialties to be happiness and the web, but don't let him get away with that humble description. He was actually the 30th employee at Facebook, the 4th employee at Mint. He's the founder of several of his own companies, including AppSumo, and he's got his popular blog, The OK Dork. When it comes to growing a business, this is the person you want to talk to. So let's put our silent virtual hands together as we introduce Noah Kagan.
Going wild. What's up, YouTube? What's up, man? How you doing, Ben?
I'm fantastic. How are you, Noah?
I'm learning how to use computers. It is a gorgeous... I'm actually in San Francisco, California today. Oh, I can't... Can I...
So it's not true that people are stopping their business travel?
I just drove, man. I think that's one of the things about business is, like, what's the problem you're wanting to solve? And just thinking about how to be resourceful. So... Do you want me to, so the audience, I love participation. So I know there's a lot of people, I like kind of knowing more what the audience is interested in. A lot of what I've been talking about in the past, I have this little iPad over here. You know, lately it's been talking about starting businesses, but if a lot of people here are business owners or operators, we can talk about that. What does the audience want? Let's poll the audience.
Well, so far we have one guy who used to see you at 24-hour fitness occasionally, so that's important.
All right, Nathaniel Reed. Hari Gopal, first-time buyer advice. All right, so let's do a few other questions. So put the QA if you're a participant. So as Ben said, Ben, by the way, we're part of the Bald Guy Club. So I will join you in that experience.
Be proud, man. Be proud.
Yeah, man. All right, first-time buyers. Is this working? Or am I in the right spot? I also love Flippa and all the Australian accents. You know, my Australian accent's off today, guys. I won't even try to do it. All right, first-time buyers. All right, so a lot of it is on first-time stuff. First-time buyers, due diligence. So why don't we do that? We have about, 30 minutes here, Ben?
Yep.
So what I want to do first off, by the way, is that I'm going to give away $500 of appsumo.com credit, which I think is the second best site after Flippa. Okay, it's first. Flippa's number 2. But AppSumo, I would say, is the best place online to buy software at a great price to start or grow a business. So if you go to okdork.com/YouTube, subscribe to my YouTube channel. I'm going to give away $500 credit live on air. We'll do it at the end. Ben, remind me if I don't do it. But
We'll do.
Pretty sure I'll do. All right. So in terms of like starting businesses, you guys post your questions. I'm just going to answer all your questions about starting businesses. So some of the things I would recommend in starting business, I haven't really bought a lot of them. The only thing I've ever bought, and I know that's what Flip is about, I bought a thing called Leo.io. Don't even go there. Don't even look at it. But it's basically a Chrome extension. And I thought like, oh, Chrome, I think sometimes when you buy businesses or you're starting a business, you think it's going to be easy, and it never is. And whenever it is easy, I'm like, okay, what's the trick? Like, what's the catch? Like, it can't be this easy. And so I bought it for $25,000, and I haven't made anything with it. And that's business. So that's what we get to learn today. I think one of the other things with business is that most of these ideas don't work. So I put out a YouTube video because I wanted to see how many business ideas have I tried in 20 years of being online. And I've done 24 of them. And only one has finally made me a millionaire after 20 years. And that's working at Facebook and working at Mint and doing Facebook games and doing consulting and doing all these different things. It was finally AppSumo. What I'm trying to tell you is that you have to try a lot of ideas out. And the other part of as you're starting these businesses, it took AppSumo about 10 years for me to become a millionaire from it. So what I'm trying to do is discourage you and inspire you to find something you want to work on for 10 years and that you stick with it for a long period of time. Another thing, especially as you guys are starting out. So yeah, I hope you guys can all get the $500, is figure out what you're fucking amazing at. Are we allowed to swear?
Sure.
Oh, pardon me.
I don't know.
Pardon me. Well, I don't know. Blake's here, the big boss man. Yeah, I mean, I think what you have to figure out is like, what is something you're excited to be working on? I think sometimes when we think we're going to buy a business, you just buy it and you run it. And the part I was saying, taking a step back as well, is with superpowers, figure out what you're great at. Like if you're a great writer, if you're a great host, maybe like Ben, if you're a great marketer, if you're great at being bald, whatever it is. What I've noticed for myself is that I felt really guilty or self-conscious that my superpower is starting. I love starting, love it. And I love marketing. Like that's like, if I could spend my whole days doing that, amazing. And I think in business, what we end up doing is feeling guilty and trying to like compensate for it. And so I'm trying to say like, well, if that's actually what I'm phenomenal at, let me go more into that zone and find people in these other areas that maybe you're not as strong at.
Yeah, it's amazing. You know, you love marketing. What do you like? What do you like best about marketing?
I love promoting greatness. I love promoting greatness. I love finding something that's phenomenal and telling the world about it. And everyone has some ability and some superpower, some skill. It's just figuring out what that is, and that does take time.
Yeah, for sure. I mean, and sorry, I know some of our guys have questions that are similar. So I'm curious, you know, especially coming from these guys who are looking to start a business. And
yeah,
the biggest step, I think, and you know, marketing is my thing as well. One of the biggest steps is like getting customers. You know, what steps have you taken that, you know, that you can maybe recommend to these people who are like, hey man, I've got this e-commerce site, I've got whatever it is, like I got a SaaS platform, I've got who knows what, you know, how are you bringing these people in to actually use your product?
Well, what's been amazing, especially with AppSumo in my career, I've done like almost every vertical. I've done games, I've done e-commerce, I've done SaaS, I've done info product, I've done content making, which is what I'm doing on YouTube. They're all different challenges. I think what I would recommend, especially if you're starting out, there's two things I would do. Number one, do the coffee challenge. So the coffee challenge is next time you buy anything, you ask for 10% off. Like yesterday, I went and got a frosé. And if you haven't had a frosé, it's phenomenal. And when I got the frosé, he like poured it in the cup and it was like right here. And I was like, bro, you only poured like a little bit. So I said, hey, can you fill up the rest of the cup? He said no. But it was actually fascinating is that is what business is. And we have a course called monthly1k.com, which is $7. And it's exactly how I start businesses. And what was fascinating about that course is that it's not the strategy of how to start a business. Like that's actually pretty straightforward. And we'll talk about customers. But the thing that's holding most people back that surprised me that I learned is fear. So the coffee challenge is you just ask for 10% off, you get rejected, you're alive, and you move forward. So that's the first thing that I've seen really change the game for people. So anyone who's wanting to start a business, I would recommend go out today with the mask, ask for a discount next time you buy anything. Second thing, I call it velocity to $1. I remember with AppSumo 10 years ago when I got my first $7 sale, that's like the best. Now I don't look, right? But that first sale, you're like, oh my God, I can't believe someone I don't know gave me money for something I like doing. And so what I encourage everyone to do, especially people starting out, is just to go get $1. Just $1. And I call it the dollar challenge. And these are kind of fundamental things in business. And I think people are saying, well, what's the strategy? There's no real more secrets. A lot of the things that are holding people back is internal. And so I like doing things that kind of get you a little bit uncomfortable, get you a little bit of momentum on the journey.
Right.
And so in terms of getting,
excuse me? Take you outside the box, get you.
Yeah, I mean, if you've been doing what you're doing, you're probably going to keep getting what you're getting. And if it's working, keep doing it, which I think is one of our strengths lately at our business. But a lot of people, if you need to push a little bit more, I think what the misconception is, I'm going to buy this Flippa thing. It's got profit. I just run it. I'm going to be rich. Sometimes you don't know what happens in the kitchen. So especially when I've started businesses, I really like doing everything in the beginning. Like I want to do the support. I want to do the development. I want to do the marketing. I want to do the sales. And then you start hiring people. And I think you have a better understanding of the business. So to get new customers, it really depends on all the different businesses. I think the thing that is literally, there's two ways that this is honestly blows my mind that people don't do it. There is more in your network than you realize. And I'm like, have you gone to every single person on your LinkedIn, literally every single person, and gone one by one to see if they could be a customer? And people are like, yeah, I kind of did it. I'm like, you haven't, especially if you're starting out. My point there, and especially starting out, just to conceptually to think about it, is look at what assets you already have access to. You don't have to make it more complicated. And then the second thing is referrals. So all those people that you went through, you're like, well, Noah, I'm British. I don't have any customers in my network. Well, like maybe you're working on the wrong business, or you need to build a better network. And then if you don't have any in your network, just ask them for referrals. Hey, do you know, so the previous guy, Up Counsel, do you know any startup that needs a lawyer? And you have to make, we can talk about referrals and stuff. But anyways, the point being is look what you already have access to that's easier. I think a lot of people start businesses way out of their wheelhouse because they are afraid of failing, and it's easier if it's like less like, oh, people will hear about it. I would think you should do the opposite. Find something you're super interested in, find problems you want to solve, and focus on those.
Yeah, 100%. There's a good question from the audience here from John. He says, what worked at AppSumo that didn't work in your other projects?
Ooh, there's things that have not. That's a really interesting question. I would say content marketing didn't work at AppSumo. It's working now, but it didn't work in the beginning. And why is because I wanted faster growth. And content marketing takes like a year. You can do it a little faster, but basically it's like I wanted the growth faster, and so it was like advertising. So I think now we spend like $100,000 a month on ads, and that's not including the people. What else has not worked in AppSumo? Things didn't work that did work now, like affiliate marketing wasn't working when I did it, and now it's a 7-figure channel for AppSumo. We haven't. Oh, you know what we suck at? Press. Like we don't really get a lot of articles. People don't talk. I mean, AppSumo is gigantic. Note to me and our team, and helping a lot of entrepreneurs out there. We call them the underdogs, is what our sumo-lings are, like the people that are going to make it. So those are kind of the two that come to mind. I think
interesting. What kind of return are you getting on the 100,000 you're spending on ads?
I think you have to be, when you're doing ad spend, what's really most important is like what's the ROI and how long is it taking? And then I think what's missed sometimes is what's the total cost? Because they're like, oh, it's this, but it's like, well, how much are you paying the person? So I actually don't know. I think the standard that we're always trying to aim for, personally, I want same day ROI. But I would say if you can do 30 days money back, like if you made your money back break even, that's promising. So when we did our ads very aggressively in the beginning, I didn't want to make any money. I wanted to build the audience base. And then the whole goal is how do we sell them the second product? So generally it's like 30 days break even.
That's a good place to be. There's another question here from Edward. Curious what your opinion might be on it. It says, is there a type of business that you suggest to be more stable? He gives examples of games, SaaS, e-commerce, etc.
If you want stable, go get a job. I mean, here's the thing that's crazy. When I left Intel, this is years ago, when I left Intel to go to Facebook, my mom was like, that's crazy. I can't believe you do that. And I think you could argue, is it crazy to waste your life doing something you don't like? That's crazy. The funny thing in that whole situation was Intel laid off 10,000 people a few weeks later. So kind of interesting. I think in terms of stability, I don't look at stability. What I think of it is more recession proof. So like, are you going to need oxygen today? Yeah. Are you going to need oxygen tomorrow? Probably. And so I think what, COVID did, which was amazing, is showed what really matters in life besides business. It showed what mattered. And I think you have to really think about how do you become more of a critical component to businesses or as a business. So let me give you some examples. So I did payments. That was my previous company before AppSumo. And there was a bunch of competitors, and it was just easy for them to like swap us out. And that sucked. And with AppSumo, I said, well, I want to be something that's oxygen to businesses. And what is oxygen to every single business? Customers. So I think you have to think a little bit more like that. What is critical, and how do I become more critical and move up the value chain? At the end of the day, I think a lot of it is customers. Either you're bringing people more customers or you're saving them a significant amount of money and time that they value. Like we built this thing called sendfox.com. It's a MailChimp competitor. And we're the cheapest. We are the cheapest. No one wants to switch because the money part didn't matter. And so we're experimenting. How do we play a game we can win? So we're moving more into content creators. So if you're a YouTuber, like youtube.com/okdork, go subscribe. I'm going to give away $500 AppSumo credit. We can win that. And so I think if it's not working, you have to figure out how do I move up the value chain, or I like calling them the totem pole because I think it's kind of a cool visual. And then maybe find an audience that is excited about what you are doing versus I think what people do way too often when they're starting is like, I'm going to appeal to everyone. And I'm like, well, the largest companies in the world started niche. Every single large company, Amazon, books, Facebook, Harvard, Google, academic research, Microsoft, DOS, right? Like developer tools. And they did it one way and everyone else is trying to do it a different way. So I'm like, maybe that's why it's not working. So in terms of stability, I think there's things that are like, what is one way to, another way to maybe ask yourself that is what will probably be around in 10 years? Like, is the internet gonna be around in 10 years? Yeah. So what can I do that will probably be around in 10 years or be needed in 10 years? Yeah,
it makes a lot of sense. One of the greatest statements that I remember from business school is just, it's a classic comment that any successful business is either a vitamin or a pain reliever. So vitamin's either just going to add some value to your life, but you don't necessarily need it. And a pain reliever is actually really lifting you up and making your day better. And those are the ones that really take off.
Yeah. I was thinking about Allbirds and shoes and socks. Like how many people are buying new socks, right? When times are good, you're like, yeah, I need new shoes and socks. But if times are bad, you're like, I could wait. And it's like, well, Shopify is interesting because people are still going to want to start businesses even more now than ever. So there is something there. And I think a lot of my career, I've been selling the tools. I've been selling the axes and the shovels. And then, with my YouTube, it's like teaching them how to use it.
Right.
And I think that'll always be around.
Yeah, that's great stuff. There's a question here from Luis, which is interesting. He says he's completely new, I suppose, to entrepreneurship in general.
Welcome.
It sounds like.
Welcome.
And he's saying, well, it's kind of a double question. I think the second part's more interesting to me. Is he says, where should I start? But how much money in terms of dollars should you start with? I mean, what kind of experience do you have? Have you started things for $10? Have you started things that need investors? How does that work on your history?
So, look, I grew up in Silicon Valley, 2 miles from Apple. I'm literally next door. One of my best friends at his house, Andrew Chen. You should follow him. He's an investor at Andreessen Horowitz. They'd write $50 million checks to companies like Airbnb and Lyft. Look, you're in Austin. Wherever you guys are in the world, there's many ways to get to Austin. Is one better than the other? It depends on your preference. My preference is you don't spend any money, you don't spend any time. You find out what people really want. And what does that mean? I don't spend any money to start businesses. What I've found to be successful is give yourself 48 hours and so then what do? Aim for 3 customers. Because 1, you can get your mom. 3 actually requires a little bit of struggle. And if it's that hard to do it to do that in 48 hours, the weekend, I call it $1 million weekend, it's just going to get harder. And the reality is that you need to find something that's easy for yourself and that people are begging you for. Think of it like push versus pull. Like you want something people are like, oh my God, give me that. Versus like, hey, let me please convince you, which I think a lot of people spend way too much time trying to convince.
Interesting.
So I would say, dude, you should be able to do it by Sunday.
100%. So it doesn't take much.
No, I think it takes about a year. This is the part that's not sexy. I would say from scratch, it takes about a year. I would guarantee if you start something or you keep trying, if you commit in a year, you'll have $1,000 a month business as long as you commit for a year. Yeah. AppSumo, I built more or less in a weekend with a guy in Pakistan. And our first year, like we did, I think a few $100,000. And then our second year, we did 3 million. And then now we're an 8-figure business. And so we did find something that was like, holy shit, this deals plus software plus like urgency works.
Yeah, interesting. There's a few more questions in here. Let me switch
dude,
through.
Bring the questions. By the way, I'll stick around either on YouTube or here. I'll try to answer as many as I can.
People will figure it out somehow. Antoinette is asking, how do you approach potential clients as a content creator?
How do I approach potential clients?
So I suppose she's a content creator or something. Maybe.
I'll tell you exactly what to do. I'll tell you exactly what to do.
Mm-hmm.
I'll tell you exactly what to do. Number 1, compliment them. So right now, get on Instagram or email or whatever it is and just compliment it. Be like, hey, I love your stuff. Here's how it's helped me. That's it. Step 1. Okay. Step 2, do the work. So what does that mean? Make it easy for them to say yes to you. So what does that look like? We are hiring a video editor. So if you go to YouTube, you can see the video editing looks pretty damn good. And so instead of like applying like, hey, I see you're doing this, send them the video. Make a video for them. Make an article for them. Make an Instagram for them. And the people I've hired recently have all done it that way. And I think it shows something about yourself. Are you going to be wasting some time? Potentially, but you'll probably improve your skills, and more likely than not, you're going to stand out. Because what everyone else does is just like, hey, I see you're doing this. Can I have a job? And so I think you want to put it as you almost want to make it a no-brainer for them that the value is obvious. Like, hey, no, I see you're doing a lot of YouTube. Here is something I made for you that should get your results or get the goal that you seem to want. Let me know what you think. And people do that, and I respond. And I think that's a better way to stand out than just like email out people.
Yeah, no, it's great stuff. I see that a lot. Here's an interesting one. Not sure what your opinion on it is. I like how it starts from Patrick. I have an online CBD cream business. A lot of those these days.
Yeah.
I've never had to advertise beyond discussing it on social, but it's growing consistently. Excuse me. He's curious, does it have more value when selling it if he's never actually had to advertise? What do you think?
So here's what he's actually asking. It's funny. I guess I've been doing this business stuff for a long time. He's like, there's all these people that are like, I never advertise. I never do this. And I'm like, all right, well, are you getting what you want? Right. And so I think what he's asked to ask himself is like, is he growing at the speed he really wants? And if he isn't, just keep doing what you're doing. I think there's a reason that Facebook is running TV ads, like online YouTube ads. I generally think that there's, if your audience is 100% of a pie, there's many different ways of approaching them. I think a lot of people advertise. The thing that's great about advertising, it's immediate and you could scale the shit out of it. The bad is that when you stop paying the drug dealers, you have to get your fix. So I find that you try a lot of different marketing channels out, but I think where we've done exceptionally well in our company, and this I'd recommend for them and anyone, is we're insane about figuring out what really works and then 10xing that. So we found ads work. So now we have a team, 5 or 6 people on ads. We found out affiliate marketing works. There's a team of 6. We found out sales work. There's a team of 10. We found out content marketing is working for us this year. So now there's a team of 9. And email marketing for us, team of 5. Wow. So I think what most people do, they're like, oh yeah, I'm doing some content. I'm like, well, how much content? It's like, oh, I write an article a week. Was it working? Yeah. If we pay $100 for the article, we make $500. I'm like, well, why aren't you doing 10 articles a day? They're like, what do you mean 10? I'm like, yeah, do 10. Well, and so my point being is I think what a lot of people do is they don't go harder on what's working and then they continue doing the stuff that's not working. So for instance, for me, like I'm doing a lot more content lately, and honestly, like Instagram and Twitter, they don't do shit. It doesn't move the needles. Like if you actually go and look at my metrics on YouTube, it doesn't drive any views. So why am I spending time there? Why am I spending money there? So I think it's just being very intentional about what's working. And if it is working, like ads, most people do it. I'd probably try it out.
Yeah. Once you know what is working, how are you making that decision that it's time to spend on it, to bring in talent, to do whatever it takes to kind of multiply?
I mean, you do it immediately. I think that's the difference between.
So if you see something ticking up, you just say, let's push it and see what happens.
1,000%. Yeah. Until it stops working. I think that's the difference. There was a lot of competitors when we launched, and I always think about restaurants. How many Mexican restaurants are there in Austin? There's a competition. So there's going to be competitors, but I think the thing I like thinking about lately is, am I an amateur or am I a professional? And you have to decide which one you want to be. And a professional, like you're going to compete against someone like me who's been doing marketing online for 20 years. And we have a team of like people that are better than me at that now. And so I think you have to decide how hardcore you want to be. And there's no right or wrong. I think you just figure out what lifestyle you want and the amount of work you want and how you want to spend your days. But I would think that most people have things working that they're not doing as much of as they can.
Yeah, that makes sense. Well, speaking of being a professional, I'm sure you get approached, I don't know, maybe daily, maybe weekly, maybe 10 times a day for people that want to buy AppSumo. What goes through your mind at that moment?
It's so funny. We haven't had as many offers as you'd think. So I'll tell you. So we're in the mid 8 figures of revenue, 20% ish or so profit margins. So it's a pretty healthy business. I love it. I love what we do. Maybe about 5 years ago, Stack Social emailed me and I said, hey, I want to sell the business. And me and my partner weren't getting along, which is inevitable in everything. It's like any relationship. You're going to have challenges. And the business was plateaued, which is inevitable in every business. And they offered like, I think 2 million cash. And like, I was pretty close to taking it. But we don't generally get a lot of offers. And I think people think about exit plans. Like we do get asked internally, are we going to sell? Are we going to go public? I think what I would encourage everyone to do is find a business you want to work on for the rest of your life. I think going public would be too much restrictions for me. And then selling would mean I'd have to go get a job. And I love my job. So I think what a lot of people, especially if you're starting out, expect it to take time, know it's going to fail. I don't know, just work on it for a very, very long time.
Yeah, no, it's true. I mean, finding something you're actually passionate about and that you're not just building to get a paycheck is very important.
Totally. The one thing I was going to say, especially if you're starting out, people are like, I want to make $1 million. I want this. I have $1 million. Figure out actually how much you need. Think about work backwards. Hey, I want a nice house in Austin. All right, that's let's say $500,000. I want to be able to retire at this age. All right, how much money actually is that? And it's probably a lot less than people people expect. And then all you have to do is get that amount. And because like when I started AppSumo, my only goal was to make $3,000 a month and go work in Thailand. That was my only goal. And that's probably still my only goal. I'm going to go back to Thailand when I can.
I'm not sure when that'll be, but hopefully soon.
Yeah. Oh, this is a good one. So have I ever created my Dream 100 list and followed through with it? Yes. So in marketing, what I recommend for everyone is instead of like, how do I do ads, which maybe you don't know, and you have to start somewhere, just write a list of your exact customers that you want. And I call it the Dream 100. And just go after them one by one. I think that one by one, I like this phrase, hand-to-hand combat marketing. And you got to do the one by one, but I think people get so enamored with a blog post or like a story that like, hey, you did ads, now you're rich. I still, like lately what I've been doing on YouTube, which I find fascinating, and I did it with AppSumo when I was working more day-to-day. I'm not day-to-day in the business. I talk to every single customer. And now on YouTube, we reply to every single comment. Either I do or someone on our team does. So it's just kind of interesting to build that kind of relationship with your customers.
Yeah, I think that's something that people often forget about so quickly. And I come from consumer goods and in a place where customers mean everything because you're literally seeing them face to face. And in the digital world, you sometimes forget that these are real people that are paying for your product.
Dude, I think one of the things that was crazy, especially if you're doing CBD oil or if you're like, hey, I want to start a business, really just go help one person. What's actually really fascinating for me, Ben, is I'm writing a book now. And if you email book@okdork.com, I can put you on the beta list for that book. But the book is about how to start businesses. What's more fascinating about that, blew my mind, was I started thinking about who I needed help from in writing this book. And then I was like, well, who have I helped? Not like, I did this for you, you better give me. What I was thinking is like, oh, who have I really helped that I can count on? And that was something to start really thinking about for yourself. Like, who have you actually helped? What are the results you've done for other people? And then maybe you'll get the results you want for yourself.
Yeah, makes sense. Can you summarize that book real quickly?
The book is How to Overcome Fear and Find Success in Your Business Journey. So it's, I would say, a modern take on 4-hour work week meets, subtle art of not giving a fuck.
I love it. Well, we only have a minute or two left. So if you want to push out that $500 AppSumo deal
let's push
again.
it out. So who should we, so here's the thing I always like doing. What time are we over?
We only got about 2 minutes.
Damn it. Okay, in 1 minute, here's what I want you to do. Commenters, people, go leave a comment here about one thing you're going to do for yourself today. And you have to be subscribed to the YouTube channel, youtube.com/okdork. But comment with one thing you're going to do. Are you going to buy something on Flippa? Are you going to reach out to Ben? Are you going to post on social media? Are you going to try to make a sale? Are you going to start ads? Post one thing you're going to do for yourself today. Especially you showed up here, which is a great thing. Okay, this is great. Anna Bernstein. Ooh, oh, there it goes. Man, you guys are awesome. The name of my book is not out yet, so I don't know what we're going to call it. You tell me. But you can email book@okdork.com, and I'll put you on the beta list. Ooh, this is great. Man, I love that you guys are going to do start Facebook ads, reach out to Ben, read your pre-release book if I send it to you. Quitting my job to start creating websites. So, Amy, let me. If you guys want to hang out, man, I'd hang out. Maybe Ben will come back and do like a marathon session. I am not a risky entrepreneur. So my day jobs have always been my investor. I worked at Facebook when I started doing like conferences, and then at Mint I built games, which got me there. And then I was consulting for a dating website called speeddate.com, and that's where I started AppSumo. I like my day job being my investor and knowing that it's going to work, and then I quit, or being pretty clear it's going to work, then I quit. But I wouldn't do it the other way around.
That's good advice. Quitting a job's not for everybody.
Dude, I'm so proud of all these people. Sharon Yang, hell yeah. Ace Murray, dude, Ace Murray, dope name. That guy sounds like a fun tennis player. I'll see you out there, mate. Love 40. Sell an e-commerce store. I've actually tried to sell on Flippa. We tried to sell kingsumo.com. I did say that recurring revenue people pay more for. That was interesting.
People very much like recurring revenue. It's valued higher than anything else.
The customers don't like it. Like, name a subscription that you love. The only subscription anyone can ever say is Netflix.
Yeah, very true. Well, we do have to wrap up. How's this working? Are you picking someone?
Yeah,
now,
let's pick someone. Here.
Go for it. You're in charge.
Awesome.
Just scroll with your mouse and whatever it lands on.
Dude. I'm going to say Tio Risquez.
All right.
So Tio Risquez, email me, noah@appsumo.com, and I will hook you up with $500 in appsumo.com credit as well.
Awesome. Congrats, Tio. Good job. And thank you. Thank you, Noah. You can stay online in the back end, Noah, and sift through these while they're coming in.
Dude, this is great. Yeah, I'll answer I'll stay till about 1, so I'll do another 30 minutes. I'll answer questions in the chat.
Cool. Fantastic. Well, I will say goodbye as we get on with Own Your Future. Thanks a lot, man.
Love you guys. Later.
Cheers.
Thanks, man.
We got another great speaker up next. Our next presenter, he is an entrepreneur and an angel investor who's been location independent, working remotely since back in 2008. At the age of 24, he actually moved from the US to the UK and founded the electronic cigarette company SkySig. He bootstrapped that business initially just out of the back of his rental car using a fake British accent. We saw Noah doing that as well. And grew the enterprise into Europe's largest e-cig brand over the course of the next 4 years. And in 2013, SkySig was acquired by L'Oreal Tobacco for $100 million and rebranded into Blue Sig. You guys have probably heard of that. And after this windfall, it was his new journey into the investment that led him to the start of the Invest Like a Boss podcast. He's visited more than 100 countries in the last decade while living off of passive income and pursuing his bucket list, which you can find online. He continues to work in startups. He's currently the founder and CEO of coworker.com. And as an investor, his portfolio includes 400 self-storage units in Hong Kong, a microbrewery in Australia, rental condos across Thailand, and several alternative assets and early stage angel investments. Join me with your silent hands as we welcome Sam Marks to the stage. Sam, thank you for being here. How you going?
Way too long, Ben. How you doing?
Fantastic. Thanks for joining us.
Good. Yeah. Thank you. Thanks, Blake. I'm glad this has got somewhat of an informal approach. I'm in a hotel in Deadwood, South Dakota, and they're actually doing construction, of course, in the room right next to me. So they put me down in this isolated meeting room downstairs.
Well, as long as your computer works and you got Wi-Fi, we're good to go.
Yeah, cool.
Take control.
Sounds good. Noah, that was awesome. Actually, when some of the profile shots of Noah reminded me of Dwayne Johnson a little bit. And I love that he was living in Thailand. We'll definitely have some things in common there. Cool, guys. So Ben, Blake, anyone on the panel, feel free to interrupt at any point if you just want to jump in and keep it informal and ask questions. But what I wanted to dive into is a little bit just in the investing. So for anyone listening, I am not a financial advisor. I'm someone actually that was really fed up with financial advisors and really just trying to figure out how to do it myself. So talk a little bit about my portfolio and how that's evolved over the last 5 years. Talk a little bit about the power of compounding interest. I'm sure a lot of you guys have heard about that, but actually when you see it illustrated, it's pretty powerful. And then for those that are kind of new to investing, I want to talk a little bit about making your first investment. And where I want to start is just talking about myself along with my co-host Johnny. So Johnny and I actually met in Thailand about 5 years ago, and we've taken a different path in life into financial success. So I was always kind of the hyper entrepreneur trying to swing for the fences and hit a home run and do it quick, where Johnny did it the practical way. So Johnny is much more living cheaply overseas, taking advantage of location arbitrage, very disciplined investing and savings. And over time, he has developed lots of small income streams that are now accumulating. But he's done it in a really, really practical approach, which I think is really inspiring. So when we met in Thailand in 2015, we're both like, hey, I just sold my business. And as an entrepreneur, a lot of you guys out there know, your income is anything but reliable or stable. It's ultra inconsistent. And after we sold the business, I was like, shit, I might not ever make money again. So I got to figure out how to live off what I have. And Johnny was in that path where he was making money, saving money, had no idea how to invest it. And we're like, you know what? Maybe the best way to figure this out is not listen to podcasts and not read books, but actually talk to the smartest people that have done it before, and then apply those learnings by applying our own money and investing our own money to learn by application. So that's what we set out to do in 2015, starting Invest Like a Boss. And each week after interviewing people, we would inevitably end up making investments in different things, dipping our toes in. So I want to talk to you real quick about what the financial dream is, right? And I think a lot of us have heard somewhere along the lines that probably the financial dream is to make enough passive income to be able to support our lifestyle. And that's great, but if you're only doing that, you're still actually living paycheck to paycheck in a sense, right? So I think we have to really dial it up a level further, where the financial dream is not only to be able to create enough passive income to be able to live the lifestyle you want, but to also have your money invested in a way that it can appreciate over time and improve and increase your net wealth. Now that's cool, because then you're supporting your lifestyle passively. But if something comes up cool, like Elon Musk goes to the moon and we want to buy that ticket, well, maybe we have enough extra to do so. So I wanted to look a little bit just at where my portfolio was post-exit. So 2013, we sold a business. I was basically financially illiterate. I'd never really made investments before. And what do most people do when they come into money? Maybe they come into inheritance, or they sell a business, or they get a bonus at work. What do you do with your money? Well, a lot of people don't know what to do with their money, or they just go knock on the door at a local bank. And in my case, it's exactly what I did. I went to UBS, I went to Morgan Stanley. I got a bunch of financial jargon, a bunch of manipulated numbers, guys in suits that look really spiffy. I said, hey, you know what? Here, take the keys. I trust you guys. You do your thing. All right. And what happened? Well, over the course of 2013 to 2016, the stock market went up. It was up about 30% during that time. And I kept looking at my balance every couple months, and my balance was the same. I kept asking questions, and finally I got fed up with it, and I started reading some books. First book I read was by actually Tony Robbins, Money Master of the Game. Fantastic book. And then I went back and started asking smarter questions. And I realized that the people that were managing my money weren't that much smarter than me after reading one book. And because I had given them the keys and trusted my financial interest to them, well, they actually made a lot of mistakes. They got in the wrong funds. They bought energy and sold it at the bottom, which is one of the worst mistakes you can make. And over the course of 3 years, instead of my account going up 30%, it was flat. And I got fed up and said, time to do this ourselves. So that's about the time I met Johnny in Thailand. And we decided, let's figure out how to invest money ourselves. So I want to fast forward real quick to how my portfolio has changed since 2015 to basically the end of 2019. And what it looks like now is it's 42 different investments. I'm not saying I'm an advocate of that. That's just where it ended up. It's a bit stretched for me. And of those 42 investments, 72 pay out a dividend or interest. I'm averaging about 5.6% yield on that. And 69% of these investments can appreciate in value. Now, some of them can't, like a bank CD that's fixed interest. You're going to get interest, but your principal can't go up in value. And then what I think is actually really cool about this portfolio is there's something that's called accredited and non-accredited investors. And for those of you that aren't aware, accredited investor is sort of a qualification that you can get when you reach a certain income level. I believe it's $250,000 a year, or a net wealth of over $1 million. And when you're a accredited investor, you have access to different types of investments that non-accredited investors don't have access to. And I think there's a big misconception that accredited investors have all the picks that they want. They can get any type of investments that non-accredited investors can't. And while that is true, you'll be surprised how many great investments out there are available for non-accredited investors. And in my portfolio, 32 of the 38 are actually available for non-accredited investors. And that means that pretty much anybody, whether accredited or non-accredited, if they wanted to, they could replicate this portfolio for the most part. So just a quick analysis of some of the investments that I'm currently in. My biggest holdings are stocks and bond funds, followed by annuities. These are pretty boring, but think of them as basically a bank CD. So it's a bank CD, but it just goes through an insurance policy, insurance company, and it pays out a fixed percent interest, something low, like 2 or 3%. And then followed up by the next biggest holding, which is real estate. A lot of that is commercial real estate, as Ben had mentioned, in Hong Kong. There's also condos in Thailand and some residential properties in the USA. And then you have all types of alternative investments, which are sort of for fun, but you of course have some cryptocurrencies in there, precious metals, Forex trading, peer-to-peer lending, mortgage servicing, REITs, all different types of things that we've sort of explored over the last few years. Just one more thing on why I do things a little bit differently or a little bit more complicated, but the annuities are really for wealth preservation. So they're creditor protected. So some of you guys might be familiar with O.J. Simpson. One of the reasons O.J. Simpson still has money, even though he's been getting sued for the last, 20 years, is because his monies are in annuities. And annuities, at least in the state of Florida and many other states in the USA, are creditor protected. They're also tax deferred, so they grow tax deferred until you decide to take money out of them. And the other thing I have in my portfolio is municipal bonds, which I really like because they're tax-free. And of course, hey, we all like tax-free stuff, right? The last part of it that I do that I guess a lot of people would be necessarily more untraditional would be startup investments. So the reason I do startup investments, not because I think that it's a get rich quick scheme or because it's the most productive thing you can do with your investments, but it helps you stay relevant, right? So when you're investing some of these startup companies, you of course have to learn about that industry, you have to learn about that company, you hopefully add value to that investment through your knowledge and resources. Also, a lot of these companies are located around the world. Some of these are in Barcelona, Singapore, Australia, Thailand. So when I travel to these places, I'm actually able to take a taxable write-off. And one other reason that I really enjoy investing in these is because it is actually a lottery ticket in your pocket. You know, some of these companies will go bust. I've had investments that have gone bust, but some of these could go 50, 100, 500, 1000x. And that's kind of exciting every time you go to sleep thinking about that. So all that aside, what would happen if you went to Warren Buffett and said, hey, Warren, hey, how about some investing advice, right? Well, Warren would turn around to you and say, as he's done over the course of his life, hey, just stick 90% of your money in the S&P 500, keep 10% in short-term treasuries, get back to work, right? Why get back to work? Because your primary income source is your easiest one to build upon. But why the 10% in US treasuries? Well, it's not because US treasuries is a way to get rich over time, but it's an emergency fund. So we just had this massive COVID crisis, which we're getting out of. The Dow Jones went down from almost 29,000 to 18,000. If you took your investments out of the S&P 500 at that time, that's the fatal mistake that you can't make that so many people do. So why keep money in treasuries? It's because it is an emergency fund, so that if you get laid off and you need to come up with cash to survive during this period, pull the money out of treasuries and you don't pull it out of your investments. Okay, so that's Warren Buffett, but what does Albert Einstein have to say, right? Smartest guy ever? Arguably the smartest guy ever. Well, Albert Einstein quoted that compound interest is the 8th wonder of the world. He who understands it earns it, who doesn't pays it. Credit card debt, stuff like that. That's extremely powerful that Albert Einstein said that, right? So, I mean, there must be something there if he's saying that. So I just want to read a little bit about compounding interest. Most of us are familiar with this term, but it's worth just repeating how it works. So when you keep money invest in an asset like dividend paying stock, you get paid out on the principal passively and at a regular frequency. When these earnings are added up to your original principal balance over multiple cycles, the interest starts to compound. Not only are you getting interest on your initial investment, but you're getting interest on top of the interest. Over the course of time, this creates an exponential snowball effect. Pretty exciting stuff. So we broke down some numbers, and this is really interesting, right? So if you invest $5,000 into, say, an S&P 500 fund, we'll just use that as our investment vehicle, you're getting 7%. It's going to take you 40 years to compound that to become $1 million. But if you just go another 9 years out to 49 years, you'll get 2 million. So you can really see how the time variable is super important to investing in compound interest. 40 years to make the first million, but just 9 years to make the next million. But what if you had 75 years, right? We'll get to that in a second, because I know 75 years is long. If you had 75 years at 7%, $5,000 a year, you're gonna have $12 million. Now, if you could get 9% instead of 7%, that's $38 million. But what's the most remarkable about that number is that actually, if you invested $5,000 over 75 years, each year over 75 years, how much does that add up to? $375,000 that becomes 38 million. And this is why Albert Einstein was so excited about compounding interest. But I know what everyone's thinking, and it's what I'm thinking, and it's exactly why I didn't start investing earlier. Well, you know what? I don't have 75 years to invest. You know, I want money now, and peak spending is between age 44 and 48. That's when we want money to be spending. And disciplined investing is difficult. So for this to work, you gotta be disciplined. You gotta stick to it. And it's tough. It's really tough. So here's the trick. It's all about accelerating timetables. No one has 75 years to invest. Yeah, it's nice maybe to invest for 75 years and leave it as inheritance to our kids. I wish my parents had done that, wish my grandparents had done that. Didn't happen. So we want to do it for ourselves. So we got to accelerate timetables, right? How do we accelerate timetables? The first thing is got to get started early. You can't put it off for another year or 2 years. You got to get started right away. This is almost my favorite one, number 2, location arbitrage. It's probably one that is most available now than any other time because of remote work. You make money in one place that you can get a good paycheck or online. You live in a cheap place. Noah was talking about living in Thailand. I spend 6 months a year in Thailand. My co-host for Invest Like a Boss is living in Sri Lanka, literally off $600 a month. So there's all these wonderful places in the world that we can now live really cheap while still making a good paycheck from our company or through working online. Also, you can maximize employer match 401ks. This is literally free money. If you're working for a company, your employer offers it, take advantage of it. It's literally free money. If you're self-employed, you can set up, in the US, it's a SEP or a self-employed 401k. If you're not in the US, your government most likely will have something that emulates this type of structure. Again, it can amplify your tax-free savings. And then of course, 7% is not cool. 9% is better, 10% is better. Over the course of 2013 to 2020, the S&P was up 13%. You can get 10% historically in the market, and no one knows what the future holds, but I think the ways the world is going, we'll be able to get that. Talk more about that in a second. But the last thing that's most important, you got to supercharge your earnings. Entrepreneurship, side hustles, real estate investments. And here's one that most people just don't think about that much. Employee stock options. So a lot of people out there are working for small companies, maybe startups. Get yourself some stock options. I have lots of friends that have made, in the range of $50,000 on up to several millions of dollars just through employee stock options. You're working for a small company, maybe you're taking a pay cut to help that company get along. Ask for some stock options. So this is my co-host, Johnny. And what I really like about Johnny, I have to be honest, is he is living, breathing proof that this works. It's not all mumbo jumbo. The math is there and he's doing it. So when Johnny and I started the podcast, his net wealth was about $200,000. And he started on this where he was building his online revenue channels. He was living overseas. He was living in Ukraine, Sri Lanka, Thailand, Bali, really inexpensive places. He was living for less than $1,000. He is now making about $100,000. He's taken advantage of what is called foreign earned income tax exclusion, which in the US means if you make $100,000 or less and you live outside the US, you don't have to pay any tax on that. So he's making $100,000, he's not paying any tax, and he's living off $600 a month. So he's literally saving almost all of his money, and he's investing it. But here's a couple other tips. You gotta pay yourself first. Simply what this means is when you get a paycheck, pay yourself first, put it in savings. Don't spend that and then try to save what's left. So if you get paid $2,000, take $200 and automatically invest that, then go spend the rest. Make it automatic. If you have to push a button at the end of each month to save and invest money, you're setting yourself up for failure, I'm telling you right now. Make it automatic, set it up so it's automatically pulling from your account each month. You don't have to think about it. And if you're investing in index funds and really any other type of investments, you got to keep the fees close to zero. We recommend Vanguard. All their ETFs and funds carry a management fee of basically less than 10 basis points now. It's extremely inexpensive. Of course, you want to make this stuff tax-free. Again, in the US, it's called a Roth IRA. In other countries, you'll have something similar for retirement savings. And again, foreign earned income tax exclusions away. In the US, you can get $100,000 of earned income tax-free each year. Then a couple other ones is you want to reinvest the earnings and the dividends straight back into the investment. Don't hold that in cash. When the S&P 500 pays you out a dividend each month, have that automatically invest and buy more shares. And then don't give into inflationary lifestyles. It happens to all of us. We make more money, we spend more money. If you can avoid that, you're gonna get to your early retirement a lot quicker. And of course, the last one is don't make that big mistake. I did this in 2008. I had about $30,000 saved up from hustling in high school, working odd jobs and golf courses and bussing tables and everything else. I was in college, the market dropped. I sold and lost about 40% of my savings. I just didn't have any intelligence about the market or market cycles. Don't make that mistake. So this is a really easy way to kind of understand how money works for you. So your money doubles at 7%, it'll double every 10 years. At 8%, 9 years. At 9%, it's gonna double every 8 years. At 10%, your money doubles every 7 years. Now, this is the funny thing. I spent 5 years trying to understand all different types of aspects of investing and creating this crazy complicated investment portfolio of 42 different investments. But if I just listened to Warren Buffett's advice, go into the S&P 500, I would be way, way up. Now, I'm not saying the S&P 500 is the best investment or the only investment you need, but it's definitely not a bad place to start. And over the course of since 2013 to 2020, it's been up 13% a year. So 13% a year, your money doubles in just 5.3 years. So I'm advocating here, we've got COVID going on. There's no better time to be thinking about owning your future. You know, I know the webinar at this event that Flippa has been putting on is, the planning for this was pre-COVID, but it's extremely timely now. There's been so many people that have been laid off. People are uncertain about the future. Now, all these things have been being talked about in this program so far. It's so true. You got to take advantage. You got to take control of your future. You can do that by investing in yourself and investing for your future. So I'd be a big advocate. If anyone's not out there investing, think about getting started today. Biggest thing is keep it simple. You want to understand what you're investing in. Probably the easiest way to get started is just investing in an index fund. So what I recommend getting started with is either VT, which is Vanguard's total stock market index. It's the total world. So it's 8,000 stocks from all around the world. You can also do VTI, which is just, it's primarily a US-based ETF. It's 3,600 stocks from around the US. But keep in mind with that, there's still international stocks. It's Microsoft, it's McDonald's, it's Starbucks. So they're very much internationally exposed. So just because you're going into a US stock index doesn't mean that you don't have international exposure. If you want to get a little bit tricky and have some fun and add a couple more funds, you don't need to, but I would recommend tilting towards small cap stocks with VBR. And by doing so, historically, you'll get a little bit better performance. Again, we don't know what the future holds. but historically a tilt towards small cap has proved to be better than just large cap. And also tech. I'm a big fan of tech. I think tech will continue to outperform in the years to come. And you can get access to that via VGT, which is Vanguard's technology index. So one good thing with our investment philosophy, actually, it's quite interesting when we step back and look at it. Johnny and I are both very much remote guys. We like being location independent. So when we make investments now, we really think about, can I do this basically with no responsibility, no management? Of course, we want diversification. So diversification is basically key to taking out the volatility of your investments. And we want to do things location independent. We don't want to have to necessarily be in one place to manage investments. And of course, we want a mix of growth and income so we can chase that financial dream of having enough income to live our lifestyle, but have enough growth that over time, even though we're living our lifestyle, our net wealth can grow. And the great thing with an index fund is that it really checks all these boxes. So Johnny was kind enough to allow me to show this. This is his dashboard in Vanguard. You can see it's just 3 funds. It's VBR, which is the small cap index fund. It's VTI, which is a total US stock market. And it's VX US, which is an international index. He's been averaging 7.6% since he got started a few years ago. And this is a very simple portfolio. 3 funds. You could do 1 fund, you could do 2 funds. But if you're just getting started, you don't need to do more than 3 funds. So I'll leave you guys with this, and this is probably the most important point to drive home. This is exactly why the rich get richer, even when they don't try. So for someone to go from $1 to $1 million in net wealth, it can take you an entire lifetime. All of your labor, all of your savings, all of your disciplined investing. It can take you an entire lifetime. But for someone that has $10 million in net wealth, to make that same million can be just 1 year of sitting back on the couch eating potato chips and being invested in a passive index fund. 10 million plus 10% equals 11 million. So you got to get started early. Now is the time. Own your future is a great slogan that Flippa put on for this event. Investing in your financial future is one aspect. And of course, all the other things that all the other guests are talking about are extremely important as well. I would implore you, if you're not investing, take it seriously. Feel free to shoot me emails, and I'll stand by for some questions. On this frame, we also have some book recommendations. This one's really good, Simple Path to Wealth. I mean, this one actually is basically 280 pages just saying all you need in your life is one index fund. I'm not necessarily a total advocate of that, but it makes a very good point there. And on Invest Like a Boss, we have 150 episodes. We've had Blake on, and we've had James Alter, who's also on the panel here on the show, and a lot of other great guests that help you learn how to do it yourself.
Amazing. That's really, it's really great stuff, Sam. And I love it because I think there's such a swing towards these risky investments these days. People on Reddit's Wall Street bets, things like that. And people are just trying to make $1 million off of $10 within a week. So it's interesting to see how much money you can make by actually being a traditional investor and just being smart with your money.
Yeah.
On that, one of the more interesting questions I think we got here is super simple, from Kimberly, excuse me. She's just saying she started stocks for her underage boys, which I'm sure is a super common thing. People trying to save some money for their kids, for college, for their life. Do you have any advice on, is it the same funds or something different if you're looking at, starting investing for a 5-year-old, or what would you look at?
Yeah, no, absolutely. So actually, depending on where she is, you can start Roth IRAs for an infant. You have to get that money attributed as earned income. So you can't just start a Roth IRA and say, here, I'm just going to give my kid $5,000 to fund it. But there's all different types of ways to make them, earned income, right? So my sister has a kid, and what I say is they have a business. Take some photos of my niece, make that niece a model for your business, put it on an advertisement, pay them $4,000 for their work, and then put that money into a Roth IRA. If you start, say, with a 5-year-old, you start a Roth IRA, which is basically tax-free retirement savings. It grows tax-free, you pull it out tax-free once they're retired. if you can get $5,000, $10,000, $20,000 in that fund in the years to come, there's almost no way that that doesn't become a lot of money. I'm talking over $1 million by the time that kid's of retirement age. So again, I would keep it simple, go into a couple, maybe 1 or 2 index funds, add to it every year if you can. And there's basically 3 things that drive the market higher over time. There's capitalism, there's growing population, and there's labor becoming increasingly efficient, internet, tractors, etc. As long as those 3 things continue, the stock market inevitably is going to go higher unless there's some cataclysmic event. Population is set to grow to 2050. I think capitalism probably will be around, and the internet is making things maybe too efficient in the world. So, I think the stock market goes higher in the next 20, 40 years without a doubt. And if you start investing now, you're going to do well.
Yeah, it's a good point. I mean, we actually went through a bit of a cataclysmic event earlier this year, yet 2 months later, the stock market seems to be back. And
I hope you were buying in the
rising.
dip then.
I wish I was buying more, but anybody who saw that coming has done quite well.
Yeah, right.
And that's where the get rich quick comes from. Well, thank you. We're unfortunately out of time. There are a few good questions here, so I will bug you behind the scenes, and hopefully we can get some more information from you down the line. But thank you so much for sharing, Sam. That was fantastic.
Thanks, guys. Appreciate it.
Our next presenter is an entrepreneur and an author of a rather new book called New Startup Mindset, 10 Mindset Shifts to Build the Company of Your Dreams. She's currently building her second startup called Adnexi. It's a strategic intelligence platform for the next generation of biopharma treatments. And prior to that, she was the founder and CEO of Seeker Health, a breakthrough digital patient finding platform, which accelerates drug development and commercialization for biopharmaceutical companies. She has an MBA in marketing and entrepreneurial management from the Wharton School at the University of Pennsylvania. She's completed the UCLA Anderson School of Management Corporate and Government certification. She's featured contributor at Thrive Global and Hacker Noon. And we are honored to have her today on our own Your Future webinar. So please put your virtual hands together, even though we can't hear you, for Sandra Spielberg.
Thank you so much for that, Ben. I'm so happy to be here. I'm going to share my screen here so I can share a couple of slides to guide the talk. Delighted to be here and talk about how to own your future, which is really the most important thing that you could do for yourself. Own your present, own your future. So what I want to talk to you about today is my startup story. Some startup myths that get in the way for many of us with starting and growing our businesses, and how to break free to actually own your future. So let's go right into it. So what's a startup? A startup is a human institution designed to deliver a new product or service under conditions of extreme uncertainty. And I highlighted extreme uncertainty because today we are all under conditions of extreme uncertainty. So no matter what you're doing, you are working at a startup, right? We are all under these conditions of extreme uncertainty. And so what that means is that we have to act fast, we have to get information from the market, and we have to take the right step. So there's a formula out there. I don't know if you noticed, but this great show, Silicon Valley on HBO, they do a really good job bringing satire to this formula that we see out there for startups. And the formula sort of says that you have to be male, likely Caucasian, Asian, or Indian. You're probably going to be a programmer. You're young. You're going to say yes to a co-founder and yes to venture funding. And you're going to try to build a unicorn, right? A unicorn or nothing, basically. So if you don't see yourself in this formula, can you drop me a little word in the chat saying, I don't see myself in this formula? Because you know what, the truth, I don't see myself in this formula. And yet I have been able to not follow that startup formula and build a company that had revenue, had customers, was profitable, and then eventually got acquired. And so I want to tell you that story, mostly so that you see a different way that this can get done and that this can turn out for you and for anyone else that is working alongside with you. So I built this company called Seeker Health. Seeker Health was a patient finding platform. So we found patients for clinical trials for biopharmaceutical companies, right? So this is a business to business type of startup. And I love B2B startups. Why do I love B2B startups? Because generally you need just a handful of customers to pay enough to sustain the company, right? And that's actually a really good test of your idea, right? Are you able to find 3 customers that will pay you a significant amount of money to use whatever service or product you have to offer? And so I built this company this way. I did not take outside funding at all. By the time I sold the company, I owned 100% of the equity. And that was because instead of taking outside funding, I looked for customers. I looked for early paying customers, first offering what I call a minimum viable service. Back then, it was these Facebook and Google advertising campaigns that were compliant for finding patients for clinical trials. And then very quickly that grew into an entire software platform. I didn't hire an expensive team. I didn't hire these adults in the room, that want to get paid $200,000, $300,000. No, not to that. I hired instead blank slates who can learn the business and serve our customers in the best possible way. I used the revenue that was coming from these customers to pay for the software development, so I didn't have to go raise. And I ran a profitable company from year 1. We had profit year 1, we had a lot more profit year 2, and a lot more profit on year 3. And I focused exclusively on acquiring customers and improving the ways that we could serve them. I'm also not the formula, so I didn't follow the formula, but I know I'm not the formula. I'm an immigrant from Latin America. I'm a woman. I'm not a programmer. I started my company at 39 years old, not 23. And I'm a wife. I'm the mother of 2 school-age kids. And I know myself that I do need 8 hours of sleep per day. I like to live a life where I get that amount of sleep. And so that's the thing, that I didn't follow the formula, and I'm not the formula, and yet the company still grew. The number of customers went up, revenue went up, profit still went up. It all went up and to the right, like we like to say in startup land. And then in 2018, I received 3 offers to acquire my startup. All these offers came from very large companies in my industry that were looking to build in this direction. And, for them, sort of the trade-off was, well, should we buy a company that's already built this, or should we build it ourselves? And one of the things that really, I think, made the difference in my company being attractive to acquirers was the fact that we were profitable, that if they acquired our company, this would be an accretive transaction, meaning we would add to the profit of their company, not subtract from it. And this, again, shifts the formula, right? Because a lot of the formula in Silicon Valley is raise money, spend all that money, raise more money, spend all that money. Well, how about we get early paying customers, they pay for us to continue to build and grow, and then we still have a profit, right, that we can show for our effort. So I ended up taking door number 3 over here, and my company was acquired in September 2018. I stayed on for a while to integrate the company, and then I decided to write this book. And I decided to write this book primarily because as I built the company, I realized that I was doing things differently than a lot of the people were, especially here in Silicon Valley, which is where I live, right? People would always ask me the same questions, right? How much funding did you raise? None. Who did you raise from? No one. And then how many employees do you have? And I would say, as few as possible. And so I realized that I was quite contrarian, and that there was a new way, a different way to think about how to start a company and how to grow it, and then eventually how to realize the value of what you built. And so one quick thing that I want to tell you is that this book today is free on Amazon on Kindle. So if you want to go get it, you can just go to Amazon and search the title of the book, New Startup Mindset. And the book is completely free today, only today, July 9th. And it is because I'm celebrating the 3-month birth of the book being out there. And so I think so far you get from me that you don't have to follow the formula, and you don't have to be the formula to own your future, but there are myths that get in the way. And so part of what I do in the book is clarify what these myths are and then dispel them. So I'm gonna pick a few, just a few, 3 of the many myths that I talk about in the book. So the first myth is unicorn or nothing. This is the myth that unless you have created a Facebook or a Google, you are nothing and your company is nothing. And as you know, nothing can be further from the truth, right? There are many companies that are built that do not reach a valuation of $1 billion, and yet they are delivering a good service or product to their customers. They're making an impact, they're making revenue, they're making profit, they're employing people, and they're paying bonuses. And all of that are things that we did at Seeker Health, and we were not a unicorn. So I like to say that right under unicorns, you have gazelles, lions, giraffes, elephants, and all sorts of really well-fed, valuable, and real animals. Myth 2 is that you are your startup. And this is important to dispel because we usually think, okay, Elon Musk is Tesla, right? And Sarah Blakely is Sphinx. But you're not your startup. You're a human being, and your startup is something you work on. And you might work on it for 1 year and be done with it. You might work with it for 3 or 5 or 10 or your entire life. But it's important to break this myth, because should your startup fail, it doesn't mean that you do, right? You move on and you work on the next thing and you get up and you try it again. So you're not your startup, you're a human being, and your startup is something you're working on for an impermanent period of time. Myth number 3, you need a co-founder. And co-founders are really popular here in Silicon Valley. However, there are some really great studies from the University of Pennsylvania that show that actually companies with a solo founder outperform those with a co-founder. And to me, this makes sense because a startup requires very quick intervention. There's a lot of quick decision-making that needs to be made. And when the monster has 2 heads instead of having 1, that becomes more difficult, right? So one monster with 1 head then can decide which direction to go with the startup. And myth number 4, you need venture capital. A lot of companies raise venture capital and a lot of companies don't raise venture capital. And many of the companies that don't is because they figured out a better way to fund their companies. The way that I funded Seeker Health, as I noted, was through early paying customers. And I am a huge fan of getting those. They validate your business. They tell you more about what they need so you can build in that direction. And they pay you for the service or product that you're providing. All right, so I want to now go into a couple of the mindset shifts that can help you begin to shift from this place of, you know, I'm not ready, I don't think I can do it, all of these barriers and obstacles and fear that many entrepreneurs and aspiring entrepreneurs face, to a place where you feel like what is happening is perfectly okay. This is exactly how it is supposed to go. And the first mindset shift is called beginner's mindset. And this is the concept that is perfectly okay for you to be a beginner at your startup, right? When I started Seeker Health, I had done a lot of things prior to Seeker Health. I worked at biopharmaceutical companies and, you know, I talked to a lot of those customers, but I had never incorporated a business or filed a trademark or filed a patent. I've not done none of that. And so the beginner's mindset is saying, you know what, there is a benefit to being a beginner. And that benefit is that, one, you're more patient, more curious, more humble, but also you're a bit free of expectations. Nobody expects me to know how to file a patent. And so I am going to go figure out how to do that in the best possible way. And so this comes from the book. And I say that if you think you need more experience before you start, then try understanding that the most relevant experience will be to begin and then to continue working on your startup. If you believe that failure is embarrassing, then try reframing that failure as an opportunity to learn, get up, and keep going. And if you desire to be honored for your past expertise and accomplishments, recognize that those are the raw material that you're bringing to your startup. And if you hear a voice that says you're not good enough, then talk to this voice and tell them, you know what, I'm just getting started. I'm a beginner here, so check back in a year and I'm gonna show you, you know, what I've been able to do. Now, I'd love to hear in the chat from you, what is stopping you today from starting or from growing or from taking the next big step? And it's not that I want you to focus on the negative, but I want you to see it, because the minute you see what is stopping you, you can then disarm it, right? You can then work on it. The second mindset shift is single deep focus. And this was super important for me as I built my company. There's a distraction monster out there, right? Lots of little things beeping our way. And so sometimes it's very difficult for many of us to concentrate. And yet the vital organs of a startup, they need our attention like we need air. And so in the book, I talk quite a bit about how to tame this distraction monster, how to become super focused and create these periods of single deep focus, right? We can't sustain that single deep focus all day long, but we could definitely do it for 2 hours when we need to work on that pitch deck that's going to go to 10 customers, right? And so those are the types of activities that really benefit from the single deep focus. And then finally, the last mindset shift I love to invite you to enable for you is to welcome difficulties. In the startup way, in the startup land, right? Difficulties are just the hurdles along the path. They are normal, they are expected. And even these closed doors, they show you the way. They show you where the water is flowing and where the water isn't flowing. And maybe you should just back up and go in a different direction. And so the concept here is to welcome, right, all of these. In the book, I talk a little bit about distinguishing between an obstacle and a closed door. And it's a bit of a deep topic, but it helps because obstacles generally help you become stronger and acquire a new skill, right, that your startup needs. While closed doors are more of a message that is telling you it's time to redirect, it's time to take a step back, pivot 90 degrees to the right and go in that direction where there aren't any closed doors. So there's a lot more of this in the book, but the key concept is these difficulties are completely expected, right? And I wrote about this because as difficult things were happening in my startup, I would often get off balance. And then I realized that they were happening pretty much every other week and that I should stop getting off balance and instead I should stop working with them. Is this an obstacle that's going to make me better and it's going to make our startup better? Or is this a closed door where I just need to say, you know what, market's not ready in that direction and it's going to take a tectonic shift for me to move this door, but the market seems to be ready in this direction, so I'm going to go there. Perfect. So with entrepreneurship, I think a lot of what I hear from other entrepreneurs, people who read the book, is that many times what stops them is this fear. It's like a very, very deep fear. It's a fear of failure. It's a fear of success. It's a fear of losing money or making too much money or hiring the wrong people or lots of fears. And I want to ask you that if you need to be afraid of anything, then channel all that fear into the enormity of what is possible, right? You can create a company, you can do it on your own terms, and you can be very successful and make an impact at the same time. So with that, I'd love to open it up to questions and answers. I think Ben is going to help me with that.
I'll do my best.
Great. Perfect.
Yeah,
so,
guys, if you want to throw them in, I know there's a few questions already, but if you got more, line them up and we'll knock them down. I do just want to remind everyone, you already mentioned, but what's the deal with you? We can get your book for free today?
That's right. That's the deal. So today only, July 9th, because we're celebrating the 3-month anniversary of the book, the ebook format, right? The Kindle format is free on Amazon. $0. Just today until 11:59 p.m. Pacific.
I like $0. We won't ask for the business model around how you're making money.
Yeah, books is a whole different thing.
Of course. There was a question from the beginning. It was talking about when you were starting your company, and you mentioned that you focused exclusively on acquiring customers. There's curiosity about what worked and what didn't in that process.
Yeah, great question. I tried a lot of things in that process of customer acquisition. I first started with my connections because this was a B2B business and I was building a solution for a problem that I was actually quite familiar with and I had connections in the industry that could be my buyer. So I started with those connections, but then, very quickly went through those. And so the things that really worked for my business were conferences, which of course now in the time of COVID-19 are much more limited, but conferences where I would get a speaking spot, I would get 10 minutes to describe what our solution was. And then immediately after the conference, I would be approached, by 5-10 people who were interested in learning more. I would then schedule a demo with them and then try to close them, right? Bring them into the sales funnel and close them. Number two, the thing that worked as well was content marketing, right? Very specific content that I wrote for LinkedIn, that I recorded in podcasts. I didn't host the podcast, but there was a podcast host, and I was talking about the content that I was interested in talking about. And those have worked very well in terms of bringing in new leads.
Yeah, that's great. It's interesting, that first point I think has been brought up by a couple of different speakers today about just maximizing the potential of your contacts, reaching out to every single person you know. I've heard that a few times today, so definitely something important to take away. Another question on here from Devin. How did you know that was the idea that you wanted to start? How did you know that?
Yeah, it's a great question. So let me take you back. So this is like the year 2015. I'm working at a startup biotech company after working at a medium-sized biotech company for 9 years. So I worked 9 years at this company called BioMarin, medium-sized. Then I went to this tiny startup, and this startup really struggled to enroll patients. I couldn't find them. And yet I knew that the patients that we're trying to find were online. I couldn't find good vendors to help me with this. I wanted to buy the system that I ended up building, and I couldn't find it. And then it ended up happening that startup, that biotech startup, decided not to continue to pursue that drug. And so I was actually out of a job. Like I actually got a severance package, 4 months paid, or whatever. And I said, you know what, this is my sign. One, I have a really clear need in the market where I wanted to be the buyer and I couldn't find it. It doesn't exist in the way that I wanted to buy it, so I can build it. And then two, this company is giving me a couple months of salary runway so that I don't have to worry, right, for the first 4 months as to where the income is going to come from, right? I have 4 months to get customers. And so that really helped. But that's how I knew. I sort of took those two signs as like, when else am I going to have as much certainty and as much sort of like forward motion to go create this thing?
Yeah, fantastic. This one, it's more of a comment than a question. It's actually an answer to your question before about what's preventing people. I'm just curious what your take might be. It's from Tammy, I know she's been with us all day. So thank you, Tammy. It's been a long day. She says, what's preventing her is choosing a business niche that resonates with her new values. She says she's already had a long career in real estate, investing, financial markets, but none of that matters to her anymore. She's trying to find a new place to land. I'm just curious, what are your thoughts on something like that?
Yeah, what I'm kind of like getting chills as I'm reading that, because that totally resonates with me as well. Obviously, like one of the business niches that is easier to choose is something you've already worked on because you can benefit from the connections. But if that isn't going to speak to you, if that isn't really aligned with what you think you need to be doing with your life, then don't do it, right? And then go into that new area, go into those new values that become important and resonant right now, and then begin to make the connections, right? I think you'll be surprised like how quickly you begin to form something new, around something that you never knew anything about. And the example I want to give you is, I was running a startup, but then I also wanted to write a book, right? And I ended up writing this book, and I had to go into this whole thing of like publishing a book and promoting a book and, getting on podcasts and whatever it might be, right? But this was something that I felt really strongly about. And when you do, then you begin taking the right steps for the right things to appear, right? You begin seeking, you begin finding, and as you do that, it doesn't matter that you haven't had a long career in this area, you can begin to pull it together.
Yeah, for sure. I mean, what's the oldest thing we've heard since we were kids is do what you love and the money will come, right?
Absolutely, yes. And I mean, you have to be savvy, right, about it. Like you have to have that disposition. I think that's one of the things that really helped me with Seeker Health, right? That I was coming from the business side. So I always had a disposition of, look, I don't want to run a company that has a loss every year. That's just like, it's just like doesn't make sense to me. I'm a business person, you know, like a company is revenue minus expenses equals profit, and there should be some profit to show at the end of the day. So of course, like, you know, there's a way to arrange that so that that is the outcome.
Yeah, for sure. There's an interesting question just came in from Eric, kind of on the other side of the table here. He's asking if there's any advice for someone who is winding down an unsuccessful startup, just to avoid feelings of defeatism.
Yeah, I hear you, Eric. You know, a lot of startups fail. And I think the best advice that I can give to you is what myth number 2 was all about. You are not your startup, right? Your startup was there to provide a product or service to a market. And there are a lot of aspects there that we don't control. Right? We don't control exactly how the market is going to receive that product. We don't control the circumstances that we live in. Like right now with coronavirus, right? A lot of budgets are slashed. A lot of difficulties are there in terms of making sales or getting traction for companies. And so all of that, Eric, you don't control. And therefore, I think it's good to have that, you know, kind of that inner sense of, here's the pieces that I could control. I tried my best. I gave it a shot. And these were the pieces I couldn't control. At the end of the day, it didn't work. And that's okay. You know, here's what I learned. Here's maybe what I would have done differently or not. Maybe there's nothing you would have done differently, but just kind of take your time to cleanse all that out, right? So that then you can be ready to start working on something new.
Yeah, that's really good stuff. Let's jump back to growing businesses opposed to declining ones. Aaron, I was curious about, again, about customer acquisitions. That's something you were focused on. He's curious how long of a window you might expect to acquire your first 3 customers. How long is too long?
Yeah, how long is too long?
Up?
This is really more relevant for my second startup, because the first startup was a little bit quicker. Like just within the first month, I had 1 customer that it looked like they were going to come on board. That kind of kept me really motivated to go get a second. You know, it depends, right? I would say in general, like 3 to 6 months, depending on your tolerance, right? Depending on your tolerance for 3 to 6 months of not having revenue, and also depending on what market you're working in. If you're working to bring in like infrastructure type of software into big companies, those sales cycles can be a year, right? But if you're looking to bring in something that a person should be able to decide yes or no, you know, within a couple of days or a week, then you would give yourself a shorter period of time. But I think as a guideline, I would say, like for me, 3 to 6 months, I need to see some signs of life, right? If there are no signs of life, then either the product has to change, our differentiators have to change, something has to change, because we tried it for 3 to 6 months and no one's buying anything.
Yeah, no, that's a great answer. Another really interesting one just came in from Ruben, definitely specific to you. He says, I'm a Mexican American. He's curious what roadblocks, if any, you've experienced as a Latina in the business world.
Yeah, I mean, I think, you know, I came to the US when I was 16. So I think I had the opportunity to get my college degree here. And, you know, all of my work experience has actually been here in the US. So I feel like I came kind of like early enough to erase most of my accent, you know, kind of like I'm Americanized in a way, a little bit. But, you know, I think some of the roadblocks are real. I saw a lot of that with my parents. You know, my parents came to the US in their 40s. And, you know, to this day, you know, my mom has a very thick accent and people react differently to you. Like a little bit of an accent like I have is like kind of cute and interesting. Oh, where are you from? You know, but like when, you know, like, yeah, it's kind of interesting to be aware of how people react. For me, mostly, I think my approach has been, you know I don't fit the mold, but I don't need to throw that in your face every single minute. And so to the extent that I can, you know, speak in the most professional way, you know, dress in the most professional way while still being me, then that's kind of what's been my approach. So I think there's been, you know, I think with the business, I don't think that I felt as much discrimination at all from being a Latina. This is my husband's last name. So it also kind of like, you know, Sandra Spielberg. I mean, that doesn't sound Latina at all. I think to some extent there was a little bit more about being a woman, right? And being this like woman CEO, you know, I was running a multi-million-dollar company and kind of like making sure that people were going to take that seriously. Like I wasn't creating this like lifestyle business that I do from my couch, right? Like this was a real thing. So I think I struggled more with that and making sure that people were going to take me seriously in that regard.
Yeah, Raymond, we only got about, I don't know, 90 seconds or so. So I'll ask you one last question. It comes from Hari, I believe is how you say it. This was again an answer to you asking why people are having a hard time kind of getting to it and starting something. And they say they're overwhelmed by the landscape. And their question is, how do you focus?
Yes, great question. It's very common to be overwhelmed by the landscape. I have a whole chapter in the book about talking to your competitors, because one of the things we're most afraid of is our competitors, how many of them there are, how quickly they're evolving. And I think it's okay to feel overwhelmed by the landscape, but it's also okay to understand that good companies are targeted companies, right? And so, for example, I didn't start a patient finding platform for any disease under the planet. I started a patient finding platform where our customers were mostly biopharma companies developing in rare diseases and in cancer. And why? Because that was the area of the market that was underserved. And that was the area of the market that was growing the fastest, right? So that's what I would tell you. If you're overwhelmed by the landscape, like who else isn't here, then maybe try to find areas that are growing the fastest, areas that are underserved, areas where you have a differentiator. You're bringing something that is going to be very good for that niche. And I think that one of the previous speakers talked about niches. Niches are really important. Like all the big companies started by serving one piece of the market really well. That's how success is built. Choose a small piece of the market and serve it perfectly.
Yeah, fantastic. Amazing. We're unfortunately out of time, but I can talk to you all day. You've got such a great perspective on this. Everyone, don't forget Kindle store or Amazon, wherever you go to get your Kindle books, New Startup Mindset. It's free today, or go tomorrow and spend some money on it, because that's even better for everyone.
Or you can buy the paperback or the hardcover.
Or buy the real book, and then you've got it forever. You can read it 100 times plus. Thank you so much, Sandra. It was fantastic.
Awesome. Thank you. Bye-bye.
Cheers. We've got just a couple more guests to go today. I'm excited for this next guy. He is someone who I worked in the music industry at the beginning of my career, so this guy kind of specifically piques my interest just because of his history. He was actually the first non-founding employee of the infamous music technology company called Napster. He went on to be the first employee and the CEO of Snowcap, a digital media services company, which was acquired by iMeme, where he continued as the COO until iMeme was acquired by MySpace. So essentially, if there was a major name in 2000s tech, he was a part of it. Nowadays, he serves as the CEO of Sporkle, a trivia behemoth, serving both the internet and pubs and online trivia these days across the United States. He's coming to us from his house in Northern California, so please put your virtual hands together for our friend, Ali Aidar.
Thanks a lot, Ben. Excited to be here.
Thank you.
All right, let me share my screen and make sure I get this right and get these slides right. All right, is that working, Ben?
Looking good.
Looking good. Okay. All right, so I'm going to talk today about my 2 decades here in Silicon Valley and what I've learned. And I like to call what I've learned the foundational constructs of business. So I'm going to get into 3 specific areas that I have learned about business that I believe are really, really foundational to building any company. So first, I know Ben just went through this a little bit, but let me characterize it a little more. So I currently run Sporkle. I've been doing that for 10 years. Sporkle is a media and entertainment business focused on trivia. And Sporkle, the interesting thing about Sporkle, and it's relevant to one of my constructs, is that Sporkle is bootstrapped. So we don't have any outside money, and in fact, we don't have any inside money. We just started making money from day one. And then prior to that, 11 years at the three companies that Ben mentioned, Napster, Snowcap, and iMeme, all venture-backed. These three companies together raised a little over $200 million. There are three components that I feel like a lot of folks don't think about as they're building their businesses. And these are things that I notice as I look at others and as I look at my past, quite frankly. And I'm going to go through each of these. So one is corporate structure. The second is what I call core beliefs. And the third is something called well-differentiated leadership. So first I'll start with corporate structure. Okay. And so there's this question around the difference between venture-backed and bootstrapped. And I can even extend this to say, not just say venture-backed, but to say taking any outside investment, whether it's friends or family or a small partner that you bring into the business versus bootstrapping it yourself. This is a question that a lot of folks just kind of ignore. And sometimes people are going straight to just raising money because that's what they read about in the press, that's what's exciting, or they think that that's really the only way to make it work. And sometimes, depending upon what you're trying to build, that is the only way to make it work. But there are also a lot of businesses that could be bootstrapped that are venture-backed instead, and they run into trouble as a result. So let me talk about the differences here. So first, let me talk about venture-backed, and I use this picture of a guy snowboarding off a cliff, and I like this picture because it really represents the thrill and the risk, if you will, associated with a venture-backed opportunity. So there are high returns available here, but there's also very high risk. And what we read about in the press are typically the ones that are really successful. What we don't read about are the 70 to 80% of venture-backed firms that don't work out, that don't go out of business. They're quickly swept under a rug. And so we're biased to those types of high returns and as our understanding of the outcome of venture-backed businesses. The second thing is you get less autonomy in a venture-backed business. You've got board members and investors who want a tremendous amount of control. And then finally, you've got less life balance. So I don't like calling it work-life balance because in many ways, work ends up being life, whether you're venture-backed or bootstrap. But when you're venture-backed, time is really important. You're trying to generate return for your investors. And in order to maximize their return, they need that return to come in. As the earlier it comes in, the higher rate of return they make. And so you've really got to focus your life on the venture. Then with bootstrap companies, so I like this picture here that kind of depicts the bootstrap company of a guy digging a hole. And there's a few things to notice in this picture. First of all, digging a hole like this is hard work. And it takes time. You can't just go and dig a hole this big and just be done with it. But also, I like to note the craftsmanship here. That hole is really well dug. It's almost perfectly dug. And you can imagine that it took a grind for him to dig that hole. And so in the bootstrap world, you're grinding out what I would call traditional rates of return, not exponential returns. That means you have lower risk. But what you get for that is you get sole autonomy. You retain control. You a lot of times in situations where investors come in, even friends and family, you end up being driven by their financial expectations, their financial goals, and not by your own goals. And so when you're bootstrapped, you really keep that autonomy. And then finally, your life profile is different. Life is what you make of it. And if you want to or need to work today, then you do. If you don't, then you don't. And that's where the autonomy and control extends to, not just in your business, but in your life. So this is something I actually tweeted about a few months ago. I believe that this is one of those things that is the single biggest decision around a company at its formation and at different inflection points when you're deciding how quickly you want to grow the business. Because you end up, whichever way you go, and again, there's validity to both ways, whichever way to go affects how you treat your customers, how you treat your employees, how you operate internally, and how you go about your life. So then the question then is, how do you choose? And look, if you're buying businesses on Flippa, and if you're buying a larger business and you require outside money, or you're stitching smaller businesses together, you will ultimately one day potentially have this choice. And there is validity in either. And as you saw in my career, I've done both. What's important is understanding how you choose. And for me, I can really boil it down to one word, and that word is trade-offs. And everything really here is a trade-off. So trade-offs being, are there really large potential returns here? Or are the returns small? Do you want to deal with high risk, or do you want to deal with low risk? Do you want complete autonomy, or are you okay with partial autonomy? Do you want to just be focused on this and your life is really focused on this, or do you want to be multidimensional? These are the types of trade-offs that you have to make. And when you make this choice, and it's okay, whatever you pick, as long as what you're picking, you're doing it with your eyes wide open, and you're thinking about the fact that you're making these trade-offs. Because if you don't, you end up like this guy. So this is a quote that I heard from somebody, a startup entrepreneur here, who made the choice of going venture back and was so overwhelmed with being in a venture-backed startup. He said, should I just divorce my wife so I could work more? And so don't be this guy. Think about this choice, make an active choice, and then proceed. Okay, so that's the first fundamental construct. So the second thing is around core beliefs. And there are these three core questions around this. So what do you believe? What is your purpose? And what are your values? So these questions are critically important. And before I get into the reasons why and why not, I'll just say at the outset of this section that when I say this to folks, a lot of people kind of roll their eyes and it's like, oh, this is too touchy-feely, or it's too woo-woo, or whatever. But the answers to these questions really form the foundation for lots of things that your business ends up doing. So let me get into that. So this quote from Jason Fried, who wrote the book Rework, this is from the book Rework: when you don't know what you believe, everything becomes an argument. Everything is debatable, but when you stand for something, decisions are obvious. And this is why understanding your core beliefs is so important. Because when you don't understand your core beliefs, you go off on tangents, you waste a bunch of time, and you're not on firm ground. So here's just an example of my current company, Sporkle, and how we encapsulate our belief, purpose, and values. So our belief is we believe in making knowledge fun for everyone. Our purpose is to create mentally stimulating diversions that bring people together. And our values are do better, truth, and inclusion. So because we have these three things, everything else naturally flows from them. When we were at a time where these weren't clearly defined, there were constant arguments, debates. Should we do this? Should we do that? One person thinking we're doing one thing, another person thinking we're doing another, and it becomes messy and confusing. So when you do define who you are and you define the belief, purpose, values, you get this internal alignment, especially if your business grows. And as your business grows, what happens is not everybody, as the business gets bigger, not everybody can talk to everybody every day. And so if you don't have these things defined, people won't necessarily row the same direction, right? So having these things defined allows people to row the same direction. It allows people to have this same decision-making lens, and it allows people to communicate clearly. There's a language that people are familiar with, that they understand, that allows them to communicate clearly. And when you don't, what happens is misalignment, people often rowing different directions, sometimes even against each other. You don't have consistent decision frameworks. And so decisions are just made on whims or personal views that one might have at the time. And oftentimes you can be in agreement with someone, yet because you don't have that shared language, it doesn't appear that you're in agreement because you're talking past each other. And so that's the power of having this belief, purpose, mindset set up in your organization. Now, again, I'll say, like, a lot of people are like, well, I don't really have to do this. It's a little touchy-feely. I'll tell you, as a startup veteran, as a CEO, and as somebody who has been invited in as a consultant or advisor to dozens of startups in Silicon Valley the last 21 years. The companies that don't do this are the ones that end up turning into a bit of a mess. And you see this time and time again when you go into organizations. So if you don't do this, that's your choice, but proceed with caution. Finally, the last fundamental construct, as I'm calling it, is this concept of a well-differentiated leader. And let me just, that's often a thing where it's like, well, what does that even mean? Does that mean a good leader? And it means a little bit more than that. and let me describe what that is. But first, let me give you this quote. This one comes from a guy by the name of Edwin Friedman, who was who's a Jewish rabbi, and but also a therapist and an executive coach for 30 years. And so he had this very wide-ranging view of families, individuals, and organizations. And he's got this book called A Failure of Nerve, which I believe is one of the best business books of all time. Certainly the best leadership book of all time. And he says this in that book. He says, without question, the single variable that most distinguished companies that survived and flourished from those that disintegrated was the presence of a well-differentiated leader. So let me talk about what that even is, and what even is a well-differentiated leader. So a well-differentiated leader is someone who has established clear goals about him or herself. So there is no murkiness about where that person is going and why. A well-differentiated leader is also somebody who is connected with their people and with what they're trying to do, but also is separate enough so that there's comfort in who they are and enough space there to challenge the people around them. So in other words, they're not so comfortable that they're chummy that they're then afraid of pushing their organization in certain ways. And then finally, and this was actually most importantly, the ability to manage one's reactivity. So to the extent you're a well-differentiated leader is one that can manage their own reactivity while everyone else is reacting. And that allows them to react calmly and take stands in times that are difficult. Now, you might be thinking, whoa, where did all this come from? Like I was talking about corporate structure a minute ago, and now I've jumped the shark all the way to something called well-differentiated leadership. And my reason for that is just how universal this really is. That this really applies everywhere. I just saw this tweet from last night, and I decided to add it at the last minute to my slides, that kind of encapsulates one part of of what I'm talking about here. This is a venture capitalist, Josh Felser, and he says, I'd take a stellar founder with a mediocre idea 100 times over a mediocre founder with a stellar idea. And yet it's not just that the stellar founder knows what they're doing and has experience or whatever, but as Friedman says, that type of leader is less likely to become lost in the anxious emotional processes swirling about. And this is so important because when you're building a business, you're going to come across difficult things that where you have to make some very difficult decisions. And if we're caught up too much in our emotions around it, we tend to make the wrong decisions because we've got so much anxiety. We'll make a decision that is more for satisfying or pacifying our anxiety than it is for as the right thing for the business. And so this is the type of thing that that you see in anytime again, I'm brought into organizations where there are problems. Almost universally, there is leadership that has not been able to handle the emotional process that is swirling about it. Now, the one thing you'll note here is I could have talked about all these other boxes here. Because traditionally, when people talk about, well, what makes a business successful? Well, it's product market fit, or it's got a good business model, or there's good distribution or sales strategy or talent or technology or whatever. And to be sure, all those things are critically important. The argument I'm making today is these layers underneath, core beliefs, well-differentiated leadership, and corporate structure are the foundation that makes all these other things possible. And if these foundational things don't have good structure or start to crumble, then these things above it start to fall apart. So that's all I have today. I'm sorry for the weird audio issues. And this is how you can reach me if you want to get in touch. I love geeking out about this type of stuff.
Appreciate it. It's fantastic. We have a couple minutes. I'll see if your video wants to work now. I know you're having an issue before.
There I am.
There you are. Beautiful. You're stunning. We'll try to fit a couple quick questions in here. We only have about 3 minutes until our next speaker. We had one come in a little earlier from Hari, who's been with us the whole time. I was curious if the core beliefs that you've had for the businesses you've run, if those evolved over time, and if you've changed those.
Honestly, they haven't. They depending on how long you run it, they can certainly evolve a little bit, but they really become the bedrock for who or what you are. And if you stay true to that bedrock, over time, it actually calcifies even more, because that's where all of your attention goes. So they actually get stronger. So it's actually very rare that it changes that much.
Interesting. And you obviously went from digital music to the world of online trivia. Did those core beliefs kind of shift to that, or what was the connection between the opportunity that you saw, the core beliefs that you had, and starting Sporkle?
Well, look, for me, music, I had to get out of the music business. Don't do anything in the music business, people. It's a tough business, unless it's like an ad-supported website. The music is tough. I saw a lot of opportunity just in building an online community. And it was the community building aspect of Sporkle that brought me over to Sporkle, because it was easy to build communities around music. Those kind of exist also in the offline world. Around trivia, there really wasn't one. And so I could bring my community mindset to Sporkle.
Yeah, no, that makes a lot of sense. There's such a tribal aspect to music that to be able to bring that to trivia or to anything else is pretty special. Let's see if I can get you one quick question. We got probably 60 seconds here before our next speaker. I know that you are a registered buyer at Flippa. What are you looking for when you're kind of browsing our marketplace?
Well, something, I'll be consistent. Something that fits with our core beliefs. Something that fits with what we believe our purpose is, and our values, and anything that allows us to enhance our belief and our purpose is what we're looking for.
Fantastic. Really appreciate you being here today. I know you got a busy schedule and quite a bit going on in your personal and business life. So
yes,
thank you.
All right.
A ton. It's fantastic.
All right. Thanks a lot.
We've got another exciting speaker ahead of us. give her a quick introduction and we'll get to it. Marketer, strategist, general manager, she's a problem solver, she's a growth builder. This next presenter helps organizations from startups all the way to established companies spot their big opportunities and solve their big problems. She has extensive experience in a wide range of digital business models, including e-commerce, subscriptions, advertising, data services, brand licensing. She herself served as the VP and head of marketing for 500 Pixels. She's a vice president at GM at iStock, at the Getty Images, and was also the executive director of strategy for Dow Jones. Currently, she serves as the managing director of digital strategy for higher education with Harvard Business Publishing. And I am really, really excited to have her with us here today. Everyone, put your virtual hands together for Ellen Demarais.
Thank you, Ben, and thank you for that nice introduction. I sound so much more impressive when you say it all like that than I think of myself being.
Oh, don't be humble.
But I wanted to say, I think some of the context of which I was really interested in talking about scale today is in this context of marketplaces. As Ben kind of talked through a bunch of my background, a lot of where I really have foundational experience in scale is for working through a variety of different digital marketplaces. And so I thought that might be helpful to sort of use as some examples as we talk through the importance of how you think about scale, because one of the really unique things comes when you're running a marketplace business is you're having to think about a two-sided equation that needs to scale together, right? You need to think about your purchasers as customers, but you also need to think about your suppliers as customers. And so a lot of things that I have formed around an understanding of scale comes from trying to actually almost use that double-sided part of your brain, figuring out how to build your business board. So let me share a brief PowerPoint with you that just kind of guide us through this conversation. Sorry, you're all like watching me with my technology. Reality of here we go today. So I have 5 kind of basic tenets I like to think about when I think about how I advise entrepreneurs on scale. And I share these tenets in the context of, I'm sure you've heard a lot of speakers today comment on scale at different stages. How do you think about getting your first 100 or 1,000 customers? How do you think about getting into the millions? What I'm going to share with you is more what I've learned that actually applies at every single stage of scaling. And it's like the 5 things that you really need to know about. The first is, how do you know your customers? It's an amazing advantage in your early days to think about how you take advantage of that time to get to know your customers. Thinking really about what their requirements are for your product or service. And not only think about what are the requirements, but what are the ways you can actually surprise and delight them. And as you think about your customers, how do you start to identify how you're going to unlock your customers as advocates? Word of mouth is one of the most powerful ways for companies to start to achieve scale in the early days. But what are the things that really matter about your product that is going to get them to tell you and to get about what is important to them? And what are the things about your product that's going to get them to tell their friends? So one of the other things that's really important about knowing your customers is knowing who to listen to. Because it's not always your early, most passionate customers that are going to be the customers that get you to scale. Early customers are often early adopters. They may be highly passionate about your product, but when you look at your market opportunity, who is your customer that fits that like mass market profile that are going to be the core customers you're going to need to scale? That's really important to start to understand and to know your customer phase. It's also the thing that really tells you if you actually picked an idea that can scale. As you think about your business, the question you should always be asking yourself is, what is the problem that I am looking to solve for my customers? Are there enough customers out there for me to build a scalable business? And will they actually pay me enough money for the privilege of doing so? And one of the things too about knowing your customers is this isn't just an early stage behavior. I think the most successful marketplaces have built this into their way of operating. And the company I usually really like to hold up as one of the best case examples of this is Airbnb. Airbnb, this is built into their operating model. It probably doesn't get more classic an entrepreneurship story than throwing 3 air mattresses on the floor of Ben Chesky's living room and saying, talking to those people the next morning, how is sleeping on my air mattress for you? Like, that's literally the origin story of Airbnb. But the really unique thing about Airbnb is that they have applied this model at every stage of their growth, of really getting in very close to their customers, taking a very human-centric approach to understanding the profile of those customers, and constantly asking them, what can we do to deliver an amazing experience for you? Because one of the things that Airbnb has understood very well is the path from knowing your customers is the path that leads to retention. And as I said, it is the path that led them to amazing customer advocacy. They turned all of their customers basically into an advertising engine for yourselves. So one of the most important things you can do in terms of figuring out to scale is know your customers. And it is never too late to know your customers, because a lot of us are struggling with how to like run our businesses in isolation time. As we're in lockdown, we can't travel. I run a global business. Normally at this time of year, I'd be traveling to India or Latin America to talk to university customers. I can't do that now, but I can certainly get on the phone with them and talk to them about their issues and problems and the things that they are struggling with right now. As I was saying too, one of the complementary concepts with know your customers is knowing how you're gonna make money. And that sounds really simple to start, but as somebody who's worked in a lot of media businesses, you start to understand that there's a lot more to unpack when you really think about how to make money. A great example of this is I worked at the Wall Street Journal. And one of the things where we were constantly debating as we created new forms of content was, do you put this content out in front of the subscription wall for free as a way to attract new customers and you would monetize them through advertising? Or do you put that content behind the subscription wall and use that as a reason why customers should subscribe for your product? So there's a lot of things to think about when you actually start thinking about how you make money. And that's both the business model as well as actually how you price. If you are building a marketplace that is based on a usage model, which was what I did at iStock, we had to make decisions about how do you price this product for an a la carte purchase, a one-off buy, versus somebody who wants to potentially use this product over and over again. Do we actually look at subscription models? The other piece of knowing how you make money is understanding the cost side of your equation. And that's, I think, one of the most key underlying business concepts that entrepreneurs have to wrap their heads around when they're trying to achieve scale. It's kind of two pieces of the cost side. Is first, your cost to acquire. And oftentimes it's really hard in your early days to actually understand what your cost to acquire should be. So your first effort should be trying to understand how much do I actually have to pay to acquire customers. And over time, you'll start to learn better how much should I be willing to pay to acquire those customers. A lot of it comes as you better understand your customer's lifetime with you so you can understand their lifetime value. The other thing about the costs that go into running your business, right? Your operating cost. As somebody who's worked through a lot of different early stage businesses, I've become a big advocate for going manual until manual is almost ready to crush you. There are amazing tools today to be used when you're running for digital businesses that can allow you to unlock value, but can also be really difficult to actually know at earlier stages of your business where you need to invest in order to create value and reduce cost. So an example would be, right, you can buy Salesforce right now. If you want to try, you think you might need a solution for managing all of your customers. You could be buying accounting software to, manage your books and things like that. There's so many different solutions, but oftentimes it's great to really start with the manual effort first. Start in a Google document, start tracking these things, figure out what parts of your business are causing you as the lead entrepreneur the most friction, or what are the things that you can invest in reducing your cost of operations that we're going to create more value for your customers. A great anecdote that I love to share around this is I started my career at Capital One, the big credit card company. And Capital One was the credit card company that actually innovated the concept of a balance transfer. Now, the idea of the balance transfer is kind of obvious to us today, right? That opportunity to take your credit card balance off one of your credit cards and transfer it to another credit card. But Capital One was actually the company that first came up with the concept. And as they started to work on the concept, they very much understood that in order to get to their millions of customers that they wanted to offer this service to, they were going to need a technological solution to get there. And there were complexity to that they both needed to be able to take those payments in from customers, and they needed to pay the other bank in order to complete the balance transfer. But one of the things Capital One also realized is that other banks in the marketplace were starting to figure this out, and speed to market was really important. So rather than wait till they had built the technology, they chose to take a very different manual approach, which kind of became a legend within the company called the bubblegum and Band-Aids moment. And bubblegum and Band-Aids was kind of their analogy for like, we're doing things scrappy in a way that nobody thinks is ideal, but it makes sure that we can go to market as quickly as possible and make sure that our customers have a good experience. So what they actually did to start doing balance transfers before they had the technology in place is they hired an army of temporary workers. They put them at tables in the corporate cafeteria, and each of those temporary workers literally wrote out checks by hand to pay off the bank balances in order to bring that to market. It allowed Capital One to be the very first company to bring the balance transfer concept to market and gave them a huge advantage over competitors in the space. It was something that they identified had huge first mover advantage, and it was worth taking that approach to begin with. And that point about first mover advantage is kind of a great transition point to my third, what you should know, and that is you should know your competition. And some entrepreneurs like to say to me, I don't have direct competition, I'm actually inventing a market. And that may be true, but in that case, you want to understand what your substitutes are. So if you don't have direct competition right now, what are your customers potentially using in place of the solution you're going to provide? But more often, you're potentially in a position where you are going to have some direct competition. And so you want to really start to build a profile of that competitor. And one of the things that's key to understanding is how closely linked your strategies are. How much will you react to each other? That was one of the big challenges of being in the credit card space is as soon as Capital One changed an offer, dropped an APR down to, let's say, 5.9% to be competitive in the marketplace, literally 2 weeks later, we would see that all of the competitors had the exact same offer in the marketplace. It was very, very hard in that space to make your price actually be your advantage point in the market. So that's one of the things you really need to think about as you think about knowing your competition is what is the advantage that you are going to have over your competitive set. And a great example of this for me actually comes from my time at Getty Images. I was running iStock, our e-commerce business, and our main competitor at the time was Shutterstock, a very similar competitive photography and image marketplace. Shutterstock was newer to the market, but they had basically built an excellent competitive playbook that made it very challenging for me as the general manager of iStock to compete with, because somebody at Shutterstock had gone through and basically figured out the weakest points of the iStock business. They had built their marketplace platform to be SEO first, while we at iStock were having to play catch up. They developed a new pricing model to offer subscriptions, which allowed high volume customers to achieve much greater discounts on their images. We did not have that as an offering. And one of the third things they did is they really developed a playbook for how to scale internationally. Shutterstock developed a very methodical approach to how they would approach every single new market they went into. They knew exactly what to do. They understood what you did in marketing approach, what you did in sales, and they were very aggressive in that regard. And so I say this as an interesting example of the point of know your competition from being caught on the other side of the equation. When I was being chased down by a competitor who had figured out all the weaknesses in my business in order to use them to their advantage. And over time at iStock, we figured out how to fill in those weaknesses. We used our brand strength as an opportunity to fight that competition. But my advice to anybody who is figuring out how to scale their business is to figure out how the competitive market plays into your decisions and how to turn some of those things to your advantage points. And as you think about then that advantage point, it kind of gets us into the fourth thing that's helpful to know, and that is your company. And when I say your company, I really think of that both as your people and your capabilities. You as the entrepreneur are the CEO leading your team on a journey. And it's your responsibility to bring people along with you and tell them where you're going. And so one of the key things as you know your company is, do you know why your company exists? Or to say it differently, Do you have a well-defined mission about what is the problem your company is there to solve? In my experience, teams that are trying to scale do their very best when everybody is looking at the same North Star. Here is the big picture of what we're all aiming for, and how are we going to get there together? It's very hard to scale when people aren't in complete alignment about where you're all trying to go together. And as you go through those different stages of scale, the thing about scale is it's really hard. It's really hard at that bubblegum and Band-Aid stage when everything is manual. And it's also really hard when you're figuring out how to get to massive scale that's enabled by technologies and new operational systems. It takes different mindsets at times as you evolve along that journey. You may need people in your company at an earlier stage who are a jack of all trades. They can wear a bunch of different hats. But as you grow over time, you may find you need to bring in more specialized expertise. But it doesn't change the point that every single stage of your company, you need to be assessing what are the capabilities that are really going to drive me toward both success and scale. And how do I continually make sure that I have the right people for the stage of the business I am in? And it's also helpful to make sure you actually have somebody in your team who has seen scale. You know, I've definitely been part of early stage teams myself, and I've also advised other early stage CEOs. And this is often one of the most challenging things on the path to scale, when there was kind of nobody that was part of that foundational team who has ever seen what a company looks like at scale. It's not to say people can't get there, but if somebody on the team at least doesn't have that experience, it's worthwhile to think about how you're going to get exposure to that and bring it in. The other thing I also like to call out, that when you think about that bringing people onto the team who have experience with scale, is making sure it's valued by the team, right? Oftentimes, sometimes entrepreneurial culture loves, to value sort of the early stage team and all the benefits that come with people who've been kind of grown up in a growth and entrepreneurial oriented culture. But it can also be really beneficial to have somebody in the team who's going to be able to tell you, when we get that big, we're going to need a platform for that. We're going to need a solution for that. We're going to need software that does this. You're going to need to build a process for that. And so I share that too as the anecdote of some of my experiences with early stage growth is, for example, when I was at 500 PX, as part of the leadership team, probably our greatest friction points as an early stage venture was really that alignment around the leadership team about what is our North Star. I joined right at the moment in time where 500 PX was pivoting from having been a pure photography community to starting to build a marketplace business. And at the moment I joined, I realized not everybody was actually aligned toward what the North Star should be. And that makes it particularly challenging because the how of scaling is hard enough. There are so many different ways to talk about what is the right way to scale and what might be the priority that your team wants to focus on. It's even harder when you don't even agree about where you're aiming to. So that's always the advice that I would give a CEO of an earlier stage company as they're figuring this out is, how clear are you on the North Star of your company? How clear are you in terms of the problem that you're there to solve? It's much easier to navigate disagreements with your team on the how you're going to do things rather than the what of what you're trying to achieve. And that kind of gets me to my fifth point and last point is, there's something in all this that means you need to know yourself. I'm speaking to all of you as CEOs in this context. Maybe you're also members of leadership teams or you're a team of one right now. But it doesn't change the point of one of the things you can do as part of being the leader of this journey is to know yourself. And that means knowing both your strengths and your blind spots. And it can be really valuable to make sure that you have people as part of your team who offset you. So if you're a very creative, visionary person, you might want to make sure you have somebody in your team who is that analytical, operational thinker. If you are somebody who is naturally a perfectionist or loves complex issues, you might want somebody in the team who always tries to simplify things. You have to then understand for yourself how to give yourself room to listen to that person. But it can be part of how you make your team great is by understanding who you are And as you have an opportunity to build out your team around you, how do you make sure that you're complementing your own strengths that are going to allow you to go forward and scale the business? And one of the questions I sometimes get asked is, well, how do I figure out like who I am in that environment? How do I learn more about myself? There are obviously like plenty of tests and assessments out there you can do. Strength Finders can be a great one. Even Myers-Briggs, when an entire team does it, can be a great way to have a dialogue. But the other thing that's probably the most simplest thing you can do is ask people. Ask people you trust. How do you react when you're under stress? How did you respond in the last really complex or difficult decision the team had to go through? And oftentimes it can actually be your family and your friends who can be hugely insightful in terms of contributing their own insights to you. So people who have oftentimes seen you in a moment of stress are sometimes the people who can give you the best advice for you to figure out how you're potentially behaving in the workplace. And so I think it's that thing too, as an entrepreneur, you always have to be very conscious of surrounding yourself with people who will tell you the truth. And the responsibility is often on you to be able to ask for that feedback. But this is something that helps you to lead from the front. And the other thing that's really important about scaling is keeping yourself healthy and figuring out what that means for you. For some people, it's getting enough sleep. For other people, it's getting a ton of exercise. Maybe it's eating well, whatever is important to you. Because the thing is, scaling is a marathon. You do not achieve scale in a business by sprinting. For some companies, this takes years and years and years. So you're going to be on a long journey for this. And so you have to figure out how you keep yourself healthy and motivated and looking forward in all this. The other thing about knowing yourself is scaling at the end of the day is a game of risk. And I was just using, the analogy of saying you're about to run a marathon. But if you really think about it, one of the things competitive marathoners do is they really plan their route. They are typically when you run, a competitive marathon, it is a well-known route. Those runners have an opportunity to analyze every step of the way. They know when they're going to take breaks. They know when they're going to switch their stride. They know where their challenge point's going to be. You as an entrepreneur get none of those benefits. And you start to recognize that every single stage of the way, I'm going to be faced with challenging decisions. And I'm going to be faced with having to make risky decisions where not all the information is available to me. So the other advice I like to give entrepreneurs is build your own personal board of advisors. If you are somebody who has taken venture capital, you may have a board that's there for your company, but you should also think then about how you complement it with the board for you. Who are mentors and advisors and people that you can go to when you're trying to work out really complex decisions about your business and even in your personal life? How do you build relationships with people you can trust who are going to keep you honest and move you forward? Because at the end of the day, you're the CEO of this business. You are the North Star. You are the person who is going to lead this forward. And you're going to have to make the decisions about where you want to delegate and where you want to be in the details. The more that you sort of build your understanding of yourself, you lead to this understanding of your business, which then allows you to kind of understand the market that you are entering into. So with that, I hope that's a little bit of helpful and ending kind of on this note of the 5 things that's good to know about yourself, your company, your competition. And with that, if we have time, then I am happy to take some questions.
We have a couple moments. That was fantastic. Thank you, Ellen. I really appreciated that. Let's see, there's a few from back. One was, how do you know when it's time? This is from your first point, is when do you kind of have an idea? When do you tell a company that it's time to start spending money on solutions and stop doing it as much by yourself as you can? Is there kind of any signals for that?
It's a great question that I wish there were super easy answers to, but a lot of it probably comes down to, sort of understanding your company. I think also too, like realizing you're typically always going to feel under-resourced, right? As an early stage entrepreneur, you may having to make a decision of, do I install this piece of software that makes the internal team's life easier? Or do I go and spend this money on acquiring new customers by paid media channels? So part of it, I think, really comes to that point of like, know how you make money. Right. And what actually can account more for you in the interim. If there's actually sort of sometimes people underestimate the value that gets created when you install some of those internal things, when you suddenly realize, wait a minute, I just freed up like 40 man hours this month, rather than needing to go and hire a new person in order to, you know, complete the accounting tables every month. I instead can funnel that money back into marketing. So I usually, when I look at this with entrepreneurs, kind of sit down and understand not only what is the decision making about that particular investment point, but what does that potential investment look like in the larger scheme of their business?
Yeah, interesting. You know, one thing you talk about a lot, I mean, kind of in the know every aspect of that, is having a North Star, you know, for yourself, for your company, whatnot. Such a hot word in business these days is pivot.
Yes.
What do you tell people when they're like, oh, well, we're pivoting to do this, or we, you know, I mean, it's essentially people shifting their North Star. What's your opinion on those concepts? How do you know if you should?
It's a really great question. And as I say, I like share the experience. When I worked at 500px, we were going through a pivot. And I will share, pivots make me nervous. I think there have been really amazing stories about entrepreneurs who have managed to pivot their business. But at the end of the day, the thing that makes a pivot successful is understanding the to from state. And what is the asset that you really carry over from where you started to where you are going? So for a lot of businesses that successfully pivot, they retain the customer relationship, and they actually retain the way they make money. Sometimes successful pivots also get oriented around, or let me say different. I find that a lot of successful pivots aren't actually about the change in the North Star. They're often the change in how you're solving for the business problem.
Interesting.
So part of it can come from down, like, so at 500px, you know, if we were like, our job is to make photographers' lives as easy as possible, as an example of a North Star, the decision on how we actually make their lives as easy as possible.
It's more about changing a road than actually changing where you're.
That's a great way to say it. You're actually like changing the path that you're on rather than the North Star. If people really start changing their North Star, and obviously there have been some meaningful examples of that. I think Instagram is a great example of a company that I think also everybody says nobody can aim to be Instagram. Right? A lot of things kind of came together to make Instagram what they were. But the majority of companies I think that successfully pivot are less changing their North Star versus they're changing how they solve a problem.
Yeah, interesting. TikTok will probably be in that discussion as well, in the way that they've changed over time.
Yeah.
Just a tactical question. What were sort of the difference in growth tactics at 500px versus iStock?
Yeah, it's a great question. One of the things that was inherently different kind of in the early stages with 500px is it started as a B2C business, and then we kind of built a B2B business on top of it. While iStock was kind of always just a B2B business. And one of the things that was actually really meaningful for unlocking growth when I was at 500px, interesting enough, was Instagram. And when I joined 500px as head of marketing, I was in a situation where the company had not chosen to use Instagram and as a marketing channel. And one of the key reasons for that was the debate about substitutes. If we were putting our stuff out on Instagram, would it mean that people didn't want to come to 500px as a platform? So a way we approached this is we actually did some like smaller scale tests of starting to put some things out, because there was a very different way to frame that question of saying the vast majority of successful photographers out there are using Instagram in order to promote their services. How can we not be on Instagram and be part of the photography community in that way? So once we figured out at 500px the way to unlock Instagram that made sense for us, it was actually then one of our most significant growth channels in terms of reaching new photographers. And as we were doing that, we were actually starting to reach clients. One of the places 500px was also most successful in the early days was they focused on a very specific part of the market, and they focused on travel photography. So Instagram was a really meaningful way to actually kind of connect with people who were looking at new travel photography in the market. So it turned out that we kind of had found this sweet spot between what was the marketing channel that both allowed us to add new photographers to our marketplace, as well as to allow new people who wanted to buy travel photography to discover us.
Yeah, no, it's interesting stuff. We only have, I don't know, honestly, we don't really have any time left, but it's just me coming up next for a quick recap. So I did want to ask you just one more question if you have a sense. What are some ways that you use to understand the strengths and weaknesses of competition?
That's a great question, because like I said, it's really helpful not to be discovering that when they're actually firing their guns right at you.
Yeah.
And like I said, that experience I had was kind of a lot of almost I stopped having to look in the rear view mirror and said, wow, we should have been investing in SEO on the platform several years ago. Wow, it turns out there was a market need to build out a subscription product. So one of the things we had actually then tried to do is a little bit of like I say, at iStock then we were kind of playing the reverse game, and we kind of really sat down and then methodically started to analyze Shutterstock. And almost a little bit of a similar framework that we just kind of went through. First, it was, are their customers actually any different than ours? Are we really fighting for the same customers? Secondly, how are they acquiring their customers? Like, are they spending a ton on media? Like, are they spending a ton on advertising? Have they built partnerships? Have they plugged into other platforms? That was one of the most meaningful ways we found to actually really get into the heart of our competition, because it allowed us then to, through that process of understanding their customers and understanding how they were acquiring them, to get into a lot of the solutions that they had built. That was actually how we figured out they had invested so much in SEO, as we tried to kind of like reverse engineer their growth numbers to figure out where they were coming from. And then we did some market testing. As an example, right, we put out a few ad campaigns on Google AdWords, and we noticed Shutterstock kept beating us. So there are some interesting ways, if you're competing in a purely digital marketing space, that you could actually be doing some testing to actually reverse engineer what some of your competitive set may be doing.
Yeah, super interesting experiments you can run in there. I like that.
Absolutely.
Fantastic. Thank you for joining us, Ellen. That was super informative.
Thank you for inviting me. Thank you all. I hope you had a wonderful day.
All right, everybody, especially everybody that's been here since we started this event, I don't know, 4.5 hours ago. Thank you for being here this entire time. It's been truly amazing. Your questions have been fantastic. The speakers have been even more fantastic. We will, of course, be chopping this up and getting it what we can online in the future. I know there were some questions that were left unanswered. We will do our best to get the speakers to answer those as well. But hopefully you came away with quite a bit of information. I jotted a few notes as we were going along, and I will just spin through those here, try to go through this in as fast as we can. To start off, we just learned that the world is moving in the direction of side hustles and becoming your own boss. There's more than ever, society is moving towards entrepreneurial efforts as a means of either earning a bit of extra income on the side or simply pursuing something that makes us happy, getting out of that corporate structure that doesn't, appeal to us anymore. We learned that no matter what, you just got to choose yourself. You want to find a way to do it. You want to be creative. And if people say you can't do it, just go out there and prove them wrong. Compound on ideas. When you're looking through Flippa, for instance, why buy one expensive business when you can buy 20 smaller ones and kind of connect them and multiply your growth off of that? We looked at a lot of data. We saw that the world, as we all know, is pretty weird. It's pretty unpredictable right now, but it is definitely showing signs that it will come back. And online is coming back faster than ever. If anything, it's actually better than it's already been already. So it's a great space to be in. We want to test products in interesting ways. I loved an idea that we heard even about using Facebook ads before you even have a product. Just put something up there and see if people are clicking on it to see if you have a viable business idea. We heard from Sieva, who owns quite a few long-term investments, about the idea of moats, about having a defensible business, something that makes it hard for other people to encroach and that you can have essentially forever and make money on that. Something we heard from multiple people is about using your contacts to enact growth. Don't be ashamed. of your idea and your needs for customers. Hit up everybody in your LinkedIn account, hit up everybody on Facebook, hit up everybody in your Rolodex if you happen to have one of those. Invest wisely. Think about long-term benefits. The rich are getting richer because they are investing and compounding their interest. They're not looking at get-rich-quick schemes. They're looking at where can I be 10 years from now. Know what you believe in. Build your business on ideals and ideas that will get you there. Make your decisions because you believe in something bigger than the business itself. And finally, know your business through and through. Know who your customers are. Know how you make money. Know who your competitors are. Know your goals, where you're trying to get, and of course, know yourself. I think all of these tips will get you one step closer to owning your own future. Hopefully we see you on Flippa at some time. We've got quite a few listings, quite a few incredible ways for you to get started owning your future. Thank you so much for joining us today. As I mentioned, we'll have recordings out sometime soon. Feel free to email us marketing@flippa.com, and have a great night, great morning, great day, wherever you are in the world. Own your future. Cheers, guys.